Okay, good morning. I think we'll call the meeting to order. We could call the roll.
Commissioner Stephanie Garcia Richard. Treasurer Laura Montoya.
Good morning, present.
DFA Secretary Wayne Props. Nick Tejas.
Present.
Catherine Allen.
Present.
John Bingaman.
Present.
Kelly O'Donnell.
Present.
Alan Sanchez.
Present.
Kurt Summer.
Present.
7 members in attendance. We have a quorum.
Terrific. Let's move on to the approval of the agenda. Is there a motion?
I move approval of the agenda.
Motion from the treasurer. Is there a second?
Second.
Didn't hear who that was.
Kurt Summer.
Okay, Member Summer. Thank you. Could we call the roll, please?
Commissioner Stephanie Garcia Richard. Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Props. Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes.
That's 7 in the affirmative. Motion passes.
Okay, let's move on to the approval of the SIC minutes from January 28th, 2025 meeting.
Motion to approve.
Motion from the treasurer.
Second.
Second from Member Sanchez. Call the roll, please.
Treasurer Laura Montoya.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Abstain. I wasn't present for the meeting.
That's 6 in the affirmative. Motion passes.
Okay, let's move on to item 2A, our State Investment Officer briefing.
Thank you very much, Mr. Chair, members of the council. I'll try to be brief since we have a very long agenda. As of last Friday, the total net asset value had crested just over $61 billion. That might soon be increasing more due to legislation that would create new funds for SIC to manage. About halfway through the session last year, we had about a dozen bills that would create new funds for SIC. Out of that, 3 crossed the finish line and became law, so that brought us to a total of 12. At this point right now, we're tracking over 30 bills that directly impact SIC. Of those, 15 would create new funds. There is some duplication in there, so it wouldn't result in 15 new funds if all of them were to pass. Obviously, we don't expect even the majority of those to pass. We anticipate probably 1 to 3 of those passing. And they vary anywhere from House Bill 520, which creates a fund but then puts no money into it, up to Senate Bill 1, which would give us a $1 billion general fund appropriation for the new fund that would be created. And then a whole host of bills in between. So it's great to see a lot of interest from legislators in trying to set aside some of the excess money that we have today to create these trust funds. We are mentioning in our analysis for each of these bills, though, that if a significant number were to pass, it would create an additional burden on the understaffed SIC, and I think in particular on the accounting side. We are going to be working to try to boost the accounting staff. The investment accounting team is a 4-person team, and we're going to try to get that to 6 in the next few months. Apart from that, I also want to alert the members of the council to Senate Bill 162. This is a bill that was sponsored by LFC. It has passed out of its first 2 committees in the Senate, and it would immediately end the New Mexico program as we know it. As the bill stands right now, we view it as being unconstitutional because the bill sets a $700 million cap on the New Mexico program. But when you look at the 20-year history of the program and look at the dollar amounts that have already been invested in the past and the binding legal commitments that we've made over the last couple of years, that dollar amount is greater than $700 million. And so we believe that the Constitution does not allow that. It appears pretty black and white. We've notified legislators and the bill sponsors. I'm working to get the bill either killed or significantly amended when it goes over to the House side because it's so problematic as it stands. However, I think it's important for the council to be aware that a lot of legislators have heard the message that SIC's fund distributions back to the general fund are expected to be able to take the place of declining oil and gas revenues over time, and they are now counting on us to do that. That really is the purpose behind this bill. They had looked at the historical poor performance of the Severance Tax Permanent Fund compared to the Land Grant Fund, and that was why this bill was passed. They wanted to send a clear directive that they want pursuit of market rate returns for both the Land Grant Permanent Fund and the Severance Tax Permanent Fund. To some extent, our New Mexico program is being a little unfairly criticized because there are also programs in there that we have had no control over. There's the 2% allocation towards the Small Business Investment Corporation, SBIC. That's in statute. We don't control that. And SBIC has a lot of great programming, but they intentionally target a low rate of return. They are impact investors. In addition, the legislature sent a couple $100 million out of our Severance Tax Permanent Fund over to NMFA for the COVID Recovery Loan Program. It was the way that program was designed. Everyone was saying at the time it was likely not only to not earn market rate returns, but likely to have negative returns, that the program would likely return less money than it used. And that's still the expectation. NMFA will be working over the next 10 years to try to get as many repayments as they can, but that program will almost certainly lose money. And that is a drag on the Severance Tax Permanent Fund. But the way the Legislative Finance Committee has been reporting it, it also shows up just in the same bucket that our New Mexico program does. And finally, we are still seeing on our books the poor performance of the way the New Mexico program used to work. We stopped giving money to a sole custodian of those funds in 2016, but we gave about $200 million to that custodian, and those investments have not turned out to provide a significant economic return or fiscal return. That's why the program was ended, but that is still on our books, still providing a drag. So while the current inception of the program, led by the efforts of Chris Cassidy and Bruce and your authorizations over the last few years, I think have really changed the trajectory of where the program is heading. We have legislators looking at that historical performance and essentially saying, please make sure that you're trying to get market rate returns. With that in mind, we've been discussing internally the situation, and we anticipate coming back with a formal policy proposal in the next couple of months, essentially to have a formal policy around where we've been heading with these investments over the last couple of years anyway. Many of the investments that we've made in the New Mexico program over the last couple of years are expected to have market rate returns. I don't think that has been necessarily clear to the public, clear to the legislature, and it's not part of our formal policy at the moment. So I think this is something that even if this bill goes away, if it dies in the House or if it gets vetoed, this is still something that's going to be a focal point of legislators. And so we're looking forward to bringing forward a policy proposal to you all in a couple of months to try to make it clear to the legislature what we're doing, why, what the impact is on New Mexico, both in terms of the economic impact from our investments, but also what we expect the returns to be long-term once these legacy programs and programs that we have had no control of come off our books, except for SBIC, which is ongoing. But with that, Mr. Chair, I'd be happy to answer any questions.
Any questions for our State Investment Officer,
Chairman, you do.
Madam Treasurer?
This, excuse me, this same bill is concerned for SBIC also. And I know that John mentioned that it may not be as impactful as they originally thought, but the same concerns are needing to be addressed with SBIC or anyone else who's investing, because long-term, it's already stuck somewhere and you can't just decide to take it out in simple terms. So, is there any way that we could formally oppose it or give direction that we completely oppose this?
Mr. Chair and Madam Treasurer, I am certainly happy to take that direction back to legislators if you're all in general agreement on that. In terms of SBIC, in the current version of the bill, they're not impacted. There was a version of the bill where they were. In the original version of the bill, we believe that the way it was structured inadvertently included SBIC's 2% as part of that total $700 million cap. That has been corrected now, and SBIC's distribution is not at risk because of the bill. It is, the cap at this point appears specifically on SIC's New Mexico program.
And Mr. Chairman, I didn't see on the fiscal impact report that the AG stated anything about it being unconstitutional. Has anyone contacted them to ask them if they think that, so they can add it to their report?
Mr. Chair and Madam Treasurer, in prior experience of asking the Attorney General's office to weigh in on unconstitutionality of bills, they are typically very wary of doing that. We could ask, but again, the law appears very black and white. It says the legislature cannot pass a law that would impinge on contractual obligations already made. And in this case, we already have contracts signed. We put out a press release just about a month ago noting that over the last 2 years, we've made $770 million in commitments under the New Mexico program. So just the last 2 years alone have more commitments than the $700 million cap of the program.
Okay, thank you, Chairman.
Thank you, Madam Treasurer. Any other questions? Hearing none, let's move to 2B, our Chief Investment Officer briefing.
Thank you, Mr. Chair, and good morning, everyone. Well, so far this year, even though it's just 2 months in, or almost 2 months in, things are playing out reasonably as we expected and talked about at the end of last year. So good, strong economy. We're growing north of 3% here in the U.S. It's a little bit different overseas, and we'll get to that. Inflation's back down. We've got that down around 3%. Although investors and market participants seem to think that we're going to ride here in this 3, maybe even 3.5% range on inflation, the 10-year Treasury yield is pretty sticky at between 4.50 and 4.60. It's an indicator that people think inflation is not going to fall into the 2s anytime soon, or we'd see maybe a little bit lower bond yield there. So still really good on the economy. Some of the the lower end of the income distribution is still struggling a little bit from the higher price level, so we're watching wages there to see if that growth will catch those folks up a little bit better. But playing out fairly well as expected. Monetary policy looks like it's on hold for at least a couple of quarters. Mainly as a function of some uncertainty around fiscal policy and trade policy. So once some of those things start to get ironed out, I think the Fed will know which direction it needs to move. But just a combination of kind of sticky inflation here in the 3, maybe 3.5 area over the next few months, combined with some policy uncertainty, I think is sort of holding rates. The Fed will hold rates where we are right now. Maybe a cut. They could do that, but not much lower. Let's see. Europe, let me talk about that just a second because has some meaning for us. The economy there's still a mess. They're just right at 0% growth, and there's a risk that they could turn down into recession in Europe. We have significant investments there in the equity markets. Sort of the silver lining is those stocks are very cheap right now, are quite cheap right now. Some of the best value that we can find in the markets reside in some of the European stocks. So we've been picking away there a little bit on our rebalancings. We'll do a little bit more this month to sort of bolster weights there. Just the underperformance of those equities versus the rest of the portfolio has drug their weights down a little bit. So we're snugging those up a bit. Did last month and snug them up a little bit more this month. Emerging markets though, still look pretty well, and, I'm really excited about the restructuring that you all approved for the international equity, or in the process of approving for the international equity, because I think it brings more active management to our emerging market exposure. So prior, we were allocated along lines of markets, so we had a static exposure to the emerging markets and active management of the stocks. With this new cap weight scheme, we now have active management not only in the stocks but also in the actual weight of emerging markets relative to domestic markets. So I think it's a good thing bringing that active management to the weight of those securities. I think that's about all the notes I have. Portfolio for the economy, portfolio wise, we're actually doing pretty well here. We are within rebalancing range. So of the smaller funds, of the 9 smaller funds, we're at long-term targets. Of the 3 bigger funds, Land Severance and ECE, we are within rebalancing range on almost all of our asset classes, with the exception of private credit and land grant. That's about 5.26% underweight. That's slightly outside the band there. And we're pretty close on private credit underweight and severance tax at about 4.05%, pretty close to the limit. But everything else, real estate, real assets, private equity, all 3 funds were within the rebalancing bands. Now they're all underweight, our long-term targets, but we are within those rebalancing bands. And of course, bonds is where that excess capital is that would go into here. That's outside of the rebalancing bands, but you suspended those bands some time ago for us to be able to deal with that. So we're getting there. I think we still have probably 18 months at least to get most of that or much of that bond exposure into the markets or into the private markets. Could be up to 24 months. We'll see how it goes. We've got a downdraft in the equity markets. That would really help in terms of getting those weights up, and getting more money into the markets. We will be bringing to you, I think it's April. Yeah, April. Some ideas about some alternative ideas on how to manage that bonds and cash exposure. So we talked about it 2.5 years ago about how we wanted to handle it. People seem comfortable with just bonds and cash, keeping it safe. But we've got some alternative ideas coming. We've been working with three of our managers about how we might otherwise manage that money. And we've got some interesting stuff. So I think you'll be interested in at least hearing about it and maybe making a change. We'll also be bringing some suggestions on changes to the interim targets, since we're getting a lot closer to our long-term targets. So looking down the road, next month, we'll be seeing you about long-term capital market assumptions and the impacts on each of the 12 portfolios. In April, we'll bring you the black dot analysis, which shows you our risk positioning and expected return positioning relative to 36 other large public plans that have the portfolios like we do. What we've been calling the completion portfolio, and that's that kind of alternative ideas about how to manage that bond and cash exposure and changes to the interim targets. Then in May, we'll be bringing you an update on inflows and update on pacing, how we're doing in both of those areas. And then in June, we'll wrap up the macro section with the 2026 annual investment plan. That'll be our 14th. We will do it in June this year. We did it in September last year. That report has got such a following that because I delayed it, I had, 100 emails in my box about where is it? You guys get it done. We want to read it. So we will get it done this year, so I can avoid that. Mr. Chair, that's what I've got. Take any questions that you have.
Great, thank you very much. Any questions on our CIO briefing, Madam Treasurer?
Yes, thank you for the briefing. As it relates to cash, how much cash do we have on hand? And how much have you seen an effect on your end as far as rates?
Well, Fed hasn't moved, so we're still seeing high 4% yields on the cash. And I think, this just off the top of my head, and I'll get you the actual number, but we're around $3 billion, maybe 3.5 on cash out of 61.
And Chairman, the reason why I ask is even though rates didn't decline, we shifted a little bit in some of our banks. They decided to go a little lower because of the SOFR rate and some other situations that they calculate into the rate in total. So as rates start to shift, that's something we do need to be attentive to. So if we're only at 3 billion, I mean, I think last year we were about 8 billion, 9 billion. That's a big difference.
Yeah, we
That's a lot of work put in.
we got a lot of work done, a lot of investments made.
Great. Thank you, Chairman.
Thank you. Any additional questions on our CIO briefing? Hearing none, we'll move to item 2C, our performance report.
Mr. Chair, I'll pass right over to RBK on that report.
Okay, thank you, Mr. Chair. Good morning, everyone. Thanks, Vince, for the introductory comments. Today, we do have the fourth quarter executive summary in your report. Maybe we can project that. As always, we'll start off with a brief overview of the capital market environment and then provide you with the fund performance. On the bottom of page 3, which should be the next page here, I think you'll see the market performance table provide some context in terms of how the quarter and the trailing year, so calendar year 2024, shaped up. Overall, quite accretive. Can you go back up a page? Great. Should one more. And so 2024, a good year despite some headwinds, both on the geopolitical and on the inflation front. So it turned out quite good, although U.S. large cap, of course, was a standout, up 25%. We've talked about the concentration there and that performance being largely driven by a handful of very large and tech-related companies that have continued to do well, despite some additional volatility that's come in through that. But you can see strong returns really across the asset classes, with the exception of real estate that is still repricing, but working its way through a recovery. So that's for the calendar year. And then on the QTD, that's quarter to date, fourth quarter, you can see a bit more mixed performance. A lot of that mixed performance, particularly in red, came in December. Markets pulled back some, particularly due to some expectations of fewer and slower rate cuts in 2025 than what were previously anticipated. Obviously, a lot of hope around rates coming down, and I think I think that for the most part that has been adjusted in terms of expectations around that. You can see the red in largely the MSCI indices. Those are foreign, non-U.S. equity related indices. They took a bit of a hit in December, largely driven by the new administration and some of the trade measures that have been put out there, and some of the implications that that would have on some of the foreign markets. That's largely reversed in 2025. So you see the market had sold off about 8% or so in the fourth quarter across the non-U.S. markets. Year to date, those markets are up about 7% compared to 2% for the U.S. markets. So made up a lot of ground in the current 2025 time period. Within fixed income, you can see the Treasury yield curve on the bottom right-hand side, very indicative of what's been happening there. Comparing the green line, that's as of year end, compared to the blue line, and that's just one quarter back. And you can see the massive movement there, really in just a one quarter period. On the short end, similar to the Treasurer's comments, cash rates and low rates have come down, but on the long end, you've seen rates coming up, and we know the inverse relationship between rates and the price of those fixed income instruments, and so you see that the Bloomberg U.S. Aggregate Bond Index had a negative 3% return, despite having higher yields, which should be beneficial on a go-forward basis. Credit spreads also came in for most of the year. That helped some of the lower credit quality fixed income instruments, but this big movement on the longer end of the yield curve held back some of the more ag-related and longer-dated fixed income instruments. I think finally, this fourth quarter is just a testament to the type of volatility that we could likely expect going forward. As you hear the performance of the funds, I think you'll be pleased and really is testament to the diversification that the SIC and staff have diligently built into this portfolio, and I think it's working well. So we'll take a look at portfolio returns next and then stand for any questions.
Thank you. So I'm going to begin on page 23 of diligent and just bring home some of the comments that Vince made about getting assets moving to your target allocation. Again, this is as of 12/31 of 2024, but there are 4 funds that have interim targets, and that is obviously land grant, severance tax, and early childhood, but also tax stabilization has an interim target. But I will say that the ones even to your interim target and those to the long-term target, where you're seeing red, it's really basis points. And again, that is that you're not within your range, and it's just a small amount. So within basis points of those targeted allocations. Taking a look at we'll look at the 3 largest fund, land grant, which is almost 56% of the New Mexico total fund. On the top left-hand side of that chart, you can see the allocations. And as Vince pointed out, there still remains to be an interim target here, but if you look at your current as of 12/31 and the minimum, so the minimum of that range, you're within, 0.3 of that minimum. So you're very, very close. Severance tax, kind of the same story. That's just under 17% of the total fund. Again, getting closer to the interims. And as Vince mentioned, there'll be new interim targets. And I believe you said April, Vince will be bringing that. If we go to the next page, and the page after that, we'll look at early childhood, which is the next biggest fund. That's 15% of the total fund, and you can see some red boxes there. This is a newer fund, but again, getting very close to that interim target. So assets have moved, and as you knew, it would take quite a while to get there, but you're moving in the right direction. If we go to page 28, we'll look at performance. This is showing for the land grant and severance tax. At the bottom, you'll see land grant. And for the quarter, you are down based on what we heard from Matthias, but you did better than your policy benchmark. And in fact, if you look across the board, in each time period, you're certainly through the 5-year, you've outpaced on a gross and net basis your policy target and at or very close for the 7 and 10. So good to see that nice outperformance for the land grant. Severance tax on the near term through really through the 3-year also net and gross performance above that policy, their policy benchmark, and moving closer on those longer term periods as well. So again, good performance for those 2 funds. Just a couple comments on attribution, which on page 13, we'll look at the full year. For the full year, as I mentioned, you outperformed your policy target. You were at 8% for land grant. The strategic allocation target was at 714. Certainly most of that came from your asset allocation. Not being at your target allocation or your interim target allocation was a slight headwind for you, but it more than was made up on manager outperformance, which is shown on the far right column on the bottom. So MS, you had a value add of 1.24% in total. So it more than made up for not being at the headwinds that you had for not being right at your target allocation. On page 33, just to point out, because it was a full calendar year, the top line is looking at the total fund, so everything including your external clients. At the end of the year, you weren't at your 61, but you're at 59 billion. You had a gain net gain of over 4 billion, but your net cash inflow is over $5.6 billion in the year of 2024. Moving forward to page 37, this is land grant. And again, you don't manage to your peers, but we did want to show the data relative to your peers. We're going to look at the all public plans greater than $1 billion. The land grant for the quarter ranked 38th percentile against those peers. You can see fiscal year to date, not as strong performance. But if you go out to the 3-year, 5-year, 7 and 10-year, you ranked in the easily the above median for the 10-year, 38th percentile, for the 5-year, 36th percentile. So if you go to the next page, looking at these 5-year rolling periods relative to your peers, really beginning with the 5-year period ending December 31st of 2013, you've been very close, above median or very close to being above median. You can see prior 5-year periods, but you've moved towards the right-hand side of the chart to more consistent performance, not trying to be at the top, in the top quartile, but consistently being above median, and it served you well. Page 39 looks at the same peer universe, but compares you to plans with similar risk. And when we look at that metric, you can see that you've been top quartile really since 5-year periods prior to 2017. So again, not as high risk as some, not as low risk as some, but when we look at similar risk, you've done extremely well on the top median. Page 41, looking at risk return. This has not changed. Left-hand side is the 5-year period. The right is the 10-year period. This just shows you a picture. The yellow and green, you can't see the green, but that's your actual land grant total fund performance. You've had above median performance, and you've got there with a lot less risk than your peers. So above median return at way below median volatility. The same is true for the 10-year period for the land grant fund. The blue and orange is severance tax. They have not done as well for reasons that we've talked about, but again, well below median volatility, just hasn't been above median on their performance. And if we go to page 43, you're going to hear from your from your specialty consultants on your alternative asset classes. But if you look at this page, this is looking at asset class composite for the public asset classes. U.S. equity, we've talked about this before, like 60% of this is passive, but you have underperformed the benchmark here. Part of that historically has been a bit of a style bias to smaller names that haven't done as well in this, and a market that's favored large. But you've improved those. The underperformance, you're not underperforming by as much. The non-U.S. equity has done quite well. You can see each time period shown, outperformance. We think you'll even do better with the changes that Greg and his team have brought forward to you. And then on public fixed income, has done a great job of beating the Bloomberg Ag in every time period shown. The last thing I want to show is if you go to the bottom of the page, and John was talking about the ETI. That's the very line there. This again is this SBIC in the loan program that came after COVID. We benchmarked that against cash. As John was saying, it has underperformed that, and just wanted to point that out since John was referencing that earlier today. And with that, there's more detail, but we're happy to take any questions that you may have.
Any questions for RVK? Madam Treasurer?
Thank you, Chairman. On page 33, the tax stabilization reserve totals, that return at 4.06, is that correct? Or what is the benchmark on that one?
the tax stabilization, let's go look at the asset allocation. This is the one, if you go to page 24, at the top left-hand side, this one still has an interim target. But you can see that this allocation is very conservative. There's no equity in this portfolio. There's the interim target's 35% low duration fixed income, so very conservative income. You have core fixed income, you have private fixed income, so the bulk of that is in fixed income, and then your alternative is real estate, so no equity, no private equity, no public equity in that portfolio.
Mr. Chairman, can you guys remind me why?
It's the states which are, it's the states which are, so we invest that very conservative.
Okay. And then on page 34, the not applicable for higher ed, capital development, and I know workforce is just a new one that came last year, but why is there no percentage return? Is that because they might all be new funds from last year? Is that what?
There's no calendar year performance.
Thank you.
Thank you. Any additional questions for RBK? Hearing none, let's move to item 2D, our real estate PMR. Director Sable.
Thank you, Mr. Chair. The content for this portion of the presentation begins on page 62 of the board books. I'll make a couple of very brief introductory comments before handing off to Rob. Very briefly, the Townsend reporting is reflecting the shift in benchmark that was made as a result of the recent structure study. As a refresher, that's a move of from Odyssey to an Odyssey plus 75 basis point premium to reflect the increased pursuit of capital appreciation versus income in the real estate book. From a performance perspective, a nominally positive return for the quarter, and overall return horizons out to 10 years, strong relative performance as well. Elevated rates are currently putting a floor under cap rates, and that's limiting appreciation returns in the short run, and that's certainly been a headwind against performance. I think with that, I'll hand off to Rob.
Thanks, Keith. Good morning, everybody. Excuse me, Rob Coaches with the Townsend Group. And I'm going to begin on page 65 of your board materials. We have a lot of material here, but we're only going to cover 5 or 6 slides today. Happy to answer any questions that you might have along the way. The real estate portfolio is currently right around, well, let me start by saying we're reporting back as of September 30, 2024. So the private markets, generally the numbers are lagged by about 90 days or so. So we're still reporting third quarter 2024 information here about your portfolio. Having said that, the portfolio, things move slowly and incrementally in private markets. So not a lot of change really from prior reports when we've been in front of you talking about the real estate portfolio. The two things that we're watching are, we've been in the middle of a market correction, and your program, we've been making a lot of commitments to try to catch up and keep up with your allocation target and your growing plan. So those are the two big themes affecting real estate today. The program as it sat September 30 was about $4.1 billion invested. And that's versus a target of about $6 billion or 12% of your total plan. So we're within your strategic ranges for real estate, but we're below the target, and that's simply a product of a slow market and a growing program that you have, and trying to keep up with your growing asset value. As Keith said, and on page 65, we show the overall performance results for real estate. And the takeaway for your program is you're performing very well relative to your benchmark, but we have had a market correction for the last 2 years now. And the small chart on the left-hand side of the page kind of shows the appreciation in real estate nationally. It's not your program, this is just the national benchmark. And you can see pretty consistent growth in values over the last decade with a little bit of a spike after COVID. And then the Fed started increasing interest rates and real estate values adjusted accordingly. So we've been, for the last 2 years now, we've been suffering with anywhere from 1 to 2% to as high as 6% in depreciated values in real estate across the market for the last 2 years. That's 1 to 2% to 6% per quarter. So it's a pretty significant correction in real estate values. Now, your program has done better. You're down 4.5% over the last 12 months, ended September 30. So on a relative basis, the program's held up fairly well, and in connection with this market correction, plus very well with respect to your benchmark. And as we look at the numbers in September, and then again as of year end 2024, there's a little bit of a crack, if you will, in this correction where the market actually delivered a positive, very slightly positive return in the third quarter of 2024, as well as the fourth quarter 2024. So we think that we've hit the bottom of this market correction, and we probably, as I like to say, will probably bounce along the bottom for a while because the market hasn't fully adjusted to the higher interest rate environment, and there's not a lot of transparency on when interest rates are going to start to decline, if at all, on the long end of the curve. So we'll just continue to plug away at real estate over the next year with modest returns we expect in 2025. Turning the page to page 66 in your book, just the next page, we like to show, you have a very large diversified real estate portfolio. You have about 36 managers in this portfolio, 71 different fund positions that you're invested with today in real estate. So it's a large diversified program with a lot of moving parts. And on page 66, we just try to give you a little bit of a snapshot of what your performance is like in the non-core funds by vintage year, so you can get an idea of how you're doing relative to the universe of investment opportunities that are available to you. And the takeaway on page 66 is that you're doing pretty well in terms of your fund selections. In about 2/3 of the years here over the last 10 years, your collection of funds by vintage year have outperformed or at least been above median or even top quartile performance. So overall, the program's doing well relative to a benchmark. And from a stock picking perspective, if you will, you've been picking good funds, good managers, good strategies that, generally speaking, are outperforming. If you want to look at all the detail of your real estate portfolio, we have that in what we call our flash report, which is way at the back of our material starting on page 93. We're not going to cover that today, but that's all the detail behind your program. Turning to the next slide on page 67, excuse me, a little bit about your funded status. As I said, currently you're at $4.1 billion invested versus a $6 billion target. That's 8.7% of the total investment portfolio versus a 12% target allocation. So we're playing catch up. And what we try to show on page 67 is I'll direct your attention to the middle-ish of the table on page 67, the unfunded commitments column. And you can see there that you have $2.6 billion of unfunded commitments in private market real estate. So you've made much more investment in terms of committing the capital than the managers have drawn and called to invest. And that's mostly by design because most managers don't want to invest a lot of money into a downturn in the market. They're looking for, waiting for the market to turn up. And another point that you could focus on page 67 is if you notice, all of those unfunded commitments have been in the non-core category. By design, we really haven't done much in your core portfolio over the last 2 years because there you tend to be, rather than making blind pool commitments where your managers are going to find investments and call capital prospectively in the core, you generally are investing in existing pools of properties. And we've been encouraging you not to invest in the core the last couple of years as market values have been declining. So you don't want to necessarily catch a falling knife, if you will. So very little core activity. We expect to come back this year in 2025 with some rebalancing efforts in that core portfolio. now that we are kind of at the bottom of this market cycle. All totaled, you have enough committed to get you to your allocation target. You're actually committed at about 119% of your target. And money's always coming back in real estate and private markets as well as going out the door. So you generally want to overcommit your target to get to the level of funded real estate that you that you allocate. And 119% is actually a little bit low. You probably could invest a little bit more still and target a little higher amount of committed capital in real estate. Turning the next page to page 68, just two more quick comments. You can see on page 68 the ramping up of the commitments that you've made the last few years as your program has grown. And on the right-hand side of that page, tracking the commitment level versus what's actually been called. And that illustrates, as I said, really since 2021, the amount of capital called by your managers has actually been declining since 2021 and kicking up a little bit over the last year or so, but still lower levels than you'd like to see. But that's because your managers are being prudent and patient with their capital. On page 69, in real estate, we track a variety of different factors, and what we can say is your portfolio is very well diversified. We look at your exposure by property type. We look at your exposure by geography. We look at how many managers and relationships you have. We look at the variety of strategies you're exposed to. And across every metric, your portfolio is very well diversified. By property type, the themes that we've been recommending the last few years, we expect to continue the next couple of years. So more focus on residential strategies, on industrial warehousing strategies that focus on supply chain change in the economy, and then more nichier property types. And we focus on those three areas because we see better income growth in those areas. And if the managers can grow the income in your portfolio, they can grow the values, and that should lead to better returns. The fund that we're presenting later on today is another fund that's focusing on a lot of these more nichier property types that have higher growth potential. Real quickly, geographically, you do have a mostly U.S. program, 80+% invested in the U.S., but almost 20% is invested overseas, and most of that is in Europe, and almost all of that's in developed markets, very little emerging market exposure in your real estate portfolio. And finally, I'll skip to page 72, and we like to put in just a compliance statement in our report every quarter. So every quarter you'll see some sort of a table like this, the bottom line is your portfolio is in compliance with all of your strategic guidelines in real estate. That's on page 72, and nothing really there to report. Probably the one that's the most challenging is just keeping up with your allocation target, given your growth and the slow market environment that we're in. So with that, I'll stop there and happy to answer any questions.
Thank you very much. Any questions related to our real estate PMR today? Hearing none, let's turn please to item 2E,
Thank you.
the real return PMR. Thank you very much.
Thank you, Mr. Chair. Again, just a couple of very brief comments. Strong quarter for real assets and real return. It's providing the diversified return stream that we own this asset class for. Returns are around 4% for the quarter. They continue to be led by the infrastructure bucket over real assets, with the exception that the MLP over the course of the last 12 months has been relatively strong. I think with that, I'll hand off to Amy.
Great, thank you, and good morning to everyone. Our report, we're going to start on page 109, titled Performance Overview. So if you look at the chart, you've actually achieved positive performance in each of the time periods that are included in that chart. During the quarter, during Q3 of 2024, you had a 3.9% quarterly gain. That equates to about $132 million gain. Since inception, the return has been a net IRR of 6.9%. That was up slightly from Q2 of this year, last quarter, which was at a 6.6% net IRR. And on the far right-hand side, you see in total, the real assets portfolio has generated $1.5 billion in gains since inception. On the next page, we break out performance by strategy. So how additive have the 5 strategies that we include in real assets been to the overall return? You see here, all have been additive with the exception of agriculture. That has now gotten back to about at cost. It is a small exposure in the portfolio, but each of the 4 other segments have been additive to the overall return. I would say the last thing is this is actually a quarter-over-quarter performance, and so year over year. And on a year-over-year basis, both the IRR and the multiple are up. On the next page, we go over the net asset value bridge, and this shows you the change in net asset value over the previous 2 quarters. So during Q3, you had a $140 million increase in your NAV. This is really driven by 2 different things. One, your contributions outpace your distributions by about $8 million. And then you also have the $132 million gain in the overall value. When we took a look at each of the funds in totality, there were 40 funds that generated gains in the quarter, 14 that generated a loss, and 5 funds that were flat. The next slide shows the top cash flows and then gains and losses. I did want to point out, you actually had 4 investments that generated gains in the quarter of over $10 million each. So that's a pretty significant amount of gains from each of those funds. And you had 1 investment that had a loss that was greater than $10 million. And then on the next page, we look at your benchmark. So your real assets portfolio is outperforming the benchmark, which is CPI plus 3%. We will have more of a discussion on that. Keith and I will be bringing the real asset structure study to next month's meeting. But you do see you are outperforming your benchmark, which is CPI plus 3%. So I'm going to end there. There's a few more slides in the back that go over diversification, a fund-by-fund performance on a quartile ranking, and manager concentration. But with that, Keith and I are happy to take any questions.
Thank you very much. Are there any questions on the real return PMR?
Just one.
Madam Treasurer.
I can't help but ask, Chairman, on the one that lost the 10 million, I'm sure you guys are looking into that as to whether or not there'll be an uptick or whether or not you should remove them from the portfolio. What's your thought?
So that is actually the real value. This was an interesting one where they sold the full portfolio and platform to another private equity firm. And so that is going to be the full liquidation value of that fund. So we would not expect an uptick there. Still, overall, it was a gain, but that is the true purchase value of the sale of their power platform to another private equity fund.
Thank you, Chairman.
Thank you very much. Any further questions? Hearing none, thank you very much for that report. And let's move on to our private debt PMR with Director Lofton and Makita.
Let's just start out real quick. Talk about remind the council again on the priorities of the program that we put in place back in 2023. And I think several of these priorities really reflected in recommendations that we're going to make today. One, as you look at the diversification across the strategy in the private credit portfolio, you'll see a clear tilt towards income-focused strategies over price return strategies. There are price return strategies, but there's a clear tilt in the program that we've been implementing since 2023 towards yield-oriented strategies. You're also going to see, and you have been seeing, as we've been trying to just given the significant liquidity in the program and the expected liquidity going forward, we're going to continue to emphasize reinvestment where possible to take advantage of compounding. And certainly you're going to see collateral diversification. Mary has two charts in Makita's presentation, two graphs, I should say, that I think really highlight the diversification and strategy side across the program. And then finally, and I think we've been making the most impact. You know, we're a $50 billion plan. We've got a $2 billion pacing that we're doing. For lack of a better phrase, that kind of puts us in the stratosphere of a big boys and girls, so to speak. And you're going to see this today in the co-investment program. We're really trying to leverage that to garner better fees from our managers and bring down fees overall. That's one of the places we can really make a strong economic impact. So with that, I'm going to turn it over to you.
Great, thanks, Tom. Good morning, trustees. So we're presenting performance for the third quarter. So this is as of September 30th of 2024. So again, New Mexico SIC adopted a long-term target allocation of 15% to private credit. We first began investing in this asset class in 2012, and we initiated a significant restructuring of the program in 2023, which is reflected in this report. So as of September 30th, we had made 59 investments representing $9.3 billion of commitments, representing a market value. So that accounts for contributions as well as distributions as well as third name value. So the market value of the portfolio was $4.4 billion. The IRRs, and apologies, I want to draw your attention to page 128. Of the presentation. So if you want to move forward one page, thank you. What I would draw your attention to are the two IRRs that we are reporting. Again, this is at the total plan level for private credit. So the 6.2 IRR is inclusive of the performance of the program dating back to 2012. You'll recall that that included a program that was heavily skewed towards hedge funds as well as traditional fixed income. So what we show in the next line, the IRR ex legacy and liquidating. So there we're excluding the performance for effectively the hedge funds and for the more traditional fixed income related funds. So we think that's more representative of the go forward performance and the go forward purpose of this program, and that's more in line with our expectations, and that was 9.9%, so effectively a 10% net IRR for this program, which we think is consistent and in line with the objectives for this program, and certainly it outpaces the private markets, the PMUs, both for both programs. So we're designing this program to target, roughly speaking, a 10 to 12% net IRR. So we think we're in line with that in terms of the restructuring of the program, but we do obviously need to report the longer term history, which again dates back to 2012. So with that, I'm going to turn your attention to the next page.
Excuse me, it's very, very faint. It changed from being we could hear you into I can barely hear Makita presentation.
Apologies. Can you hear me better now?
Yes, that's.
Oh, I'm so sorry. I think my mic was not turned on. So I'm happy to quickly review that if that would be helpful for the trustee.
That's okay. Thank you.
Okay, great. The punchline tied to the IRR that we're presenting both for the overall program, which is 9.9%, which we think is more representative than the longer dated performance, which is inclusive of your hedge fund and traditional fixed income program, which dates back to 2012. So I have turned to the next page of the presentation, which shows on a market value basis. And when we presented the restructuring of the program in 2023, we outlined for you kind of the broad strategy allocations that we're seeking to target. And so here we're showing this on a market value basis. So we're targeting a policy allocation of 20% in direct lending, 25% in asset-based lending, 30% in special situations, and 15% in diversifying assets. On a market value basis, we're not quite there yet. The direct lending allocation is largely in line with that target allocation at 26%, but we effectively, you didn't have much asset-based exposure in the program at the time of the restructuring. So that, as we've articulated to the committee, is a key focus and one of the managers that we're bringing forward today. But you are significantly underweight relative to policy target. On a market value basis, you're roughly at 9% of the program. Again, we're looking to grow that over time. Special situations is at 25%. And the diversifying component is obviously the one that really sticks out at 40% of that allocation. We would highlight that's a bit of a catch-all type of bucket. And what we're going to do next quarter is break out for you the real estate debt component so that you'll have more granularity from a reporting basis. And we are targeting, Tom wants to target a 10% target allocation to commercial real estate debt. And so we'll provide more granularity for you on a go-forward basis. So with that, I think this is the chart that Tom was alluding to on the next page. I think this chart on the left as well as on the right illustrates what we've been trying to articulate in terms of the significant restructuring of the program in the 2023 timeframe, with that blue component in the liquidating, effectively dominating the portfolio until the 2023 timeframe, and then falling off significantly because it wasn't predominantly in public assets, so we were able to sell out of it relatively quickly. But it does take a while to ramp up a new program, which is what we're doing. So with that, I would draw your attention to the next page. 131, where we provide more granularity for you in terms of committed, contributed, unfunded, distributed, and then breaking out on a strategy level basis for you the IRR. So hopefully this provides more granularity for you. So as already mentioned, you have 59 investments at the total fund level, representing $9.3 billion of commitments. When you strip out the liquidating and the legacy, that brings down the committed capital to $7.2 billion and the number of commitments to 46. So your asset-based component is roughly $775 million in terms of committed. It represents 4 commitments. Your direct lending component represents $2.2 billion of commitments across 12 commitments. Both your asset-based as well as your direct lending are roughly generating an IRR on a net basis, so a net IRR of 11%. Your diversifying component, which represents 16 investments and roughly $1.9 billion, is generating an IRR of 10.2%. The legacy commitments, 5 remaining investments in the portfolio, $310 million in terms of commitments. That IRR, again, is one of the things that's dragging down the total fund performance. That has an IRR of 4.2%. The liquidating components, so 8 remaining investments on a committed basis of $1.8 billion. We would highlight that the remaining market value for that is quite low at roughly $33 million. But that performance, which does tie into the net IRR that we highlighted at the total fund level, was 3.4%. So again, one of the drags in terms of the overall performance for the overall portfolio. Special sits, 14 commitments representing $2.4 billion of committed capital, generating a net IRR of roughly 9%. So that gets you to that 6.2% inclusive of both liquidating as well as legacy. When you strip that out, that gets you to the 9.9% percent, which again, we think is more representative on a go-forward basis. I'm going to skip over the recent quarterly commitments. You're familiar with that, and I'll draw you rather to the page 133, excuse me, of the portfolio that shows in total the commitments that were done last year in private credit. So this is inclusive of both October as well as November, so inclusive of the fourth quarter commitments as well. So you did commit $1.9 billion to private credit last year, so slightly below the target of $2 billion of commitments, but we always have the expectation of a little bit of wiggle room around that. So the rest of the presentation really is broken out and provides you with more granularity, broken out by vintage year, broken out by strategy. We do have some slides that highlight the market environment, but I was going to stop there and see if there are any questions for the trustees, but hopefully that provides you a good flavor for performance.
Thank you very much. Are there any questions regarding the private debt PMR?
Just one, Chairman.
Madam Treasurer?
The 3.4 IRR with the liquidating the hedge fund one, how long do we have that one on our books for?
You should receive, so there are side pocketed assets in that, which represents the majority of the remaining exposure. So unfortunately, one of the challenges with side pocketed assets is they can be outstanding for quite some time, and it's difficult to provide you with a specific date in terms of when you're going to get your money back, which is one of the reasons in many cases that we prefer private credit to hedge funds, because of the transparency provided in terms of the liquidation. So unfortunately, I don't have I can't provide you, because the manager can't provide us with a distinct answer in terms of when you'll get that money back.
Thank you.
Thank you very much. Any additional questions? Hearing none, thank you for that report. And let's move on to our national private equity PMR, Director Cassidy and Mercer.
Morning, everyone. This starts on the materials for this, start on page 157. The national program portfolio is generally behaving well. As we've been discussing, when we ramp a portfolio like this, we're doing the best we can to figure out ways to minimize J-curve. It's still, the portfolio did beat its in index for the year, 3-year and 5-year. But one thing that we're, is becoming a little more evident in this report, we made some of our first co-investments during this quarter with Mercer through their vehicle, and some of the commitments we've been making over the last year finally show up in the reports, specifically Bain Special Sits, which was a large commitment, which allowed us to put meaningful capital to work right away. Pass it on to Richard for more detail.
Thanks, Chris. Thanks, Mr. Chair. I'm going to start on page 160 of the materials. We're covering Q3 2024 performance today. We did have a gain in the quarter of 3%, which equates to a value of $122 million. That was the strongest quarterly performance we've had in the last couple of years. It also beat the quarterly benchmark against the all private equity benchmark. The 1-year return is 7.6%, so you can see kind of those lower returns in private equity that we've seen in recent years, evident in the 1-year and the 3-year returns of 7.6% and 5%. But as Chris mentioned, they are beating the global private equity benchmark. Overall, the since inception return didn't change at 12.1% or an over $4 billion gain. When you look at the portfolio 2011 and after, which represents the new private equity strategy that was implemented in 2011, I mean, you see a net IRR of 15.1% and over $3 billion of gain. Turning to the next page, we did have a large increase in net asset value. The net asset value increased by about 418 million, and that was driven by both the gain and the contribution. If you turn to 162, you'll actually see in the chart that the 122 million gain there on the right, but we had almost 400 million of contributions in the quarter, and slightly offset by about 100 million of distributions. We also had a favorable gain loss ratio where 80 funds were reporting gains, 47 were reporting losses. And for 2024 total, I mean, it was a net contribution year where we had net contributions of 374 million. We did have a healthy amount of distributions though, at almost 500 million of distributions received from the older funds in the private equity portfolio. But we don't anticipate distributions exceeding contributions over the future because of the commitment activity that we've been doing over the last few years. Skipping ahead to 164, I want to talk a little bit about benchmarking. One of our goals with benchmarking is we really want to target above median performance in any vintage years because we're trying to create a diversified portfolio of funds and monitor those exposures to manage the risk in the portfolio. And you can see since 2011, performance has generally been above median in all years except 2013 on the net multiple, and even that one, it's really close to the median cutoff. And right now we're generating top quartile performance in the 2016 and 2019 vintage year. When you look at just absolute performance too, I mean, we have every vintage year generating a 10.4% or greater return as well. The next page, 165, shows the public market equivalent performance. And you've probably seen the headlines about private equity's performance versus public equity. And if you look at the Russell 3000, we are underperforming the Russell 3000. That's the benchmark that has a lot of the exposure to the Mag 7 that has been causing this underperformance. But when you look at the Russell 2000, which is the smaller companies in the Russell 3000, it is outperforming that benchmark by about 3.3%, which is what you would expect to see with private equity normally. And the MSCI ACWI, which is a more global benchmark, we're outperforming that by about 2.9%. We have some more slides on the details, but I think I'll conclude my remarks there and happy to answer any questions.
Any questions on the National Private Equity PMR? I did have actually one question for Mr. Pugmire on page 160. The 15.1% net IRR since inception for the 2011 and after commitments. Remember a few years ago, that number was about 20%. Is it fair to say that that number has come down in large part because of all the commitments and contributions, like basically the J curve of all the money we've been deploying rather than like a degradation of the underlying assets?
Yes. You know, a lot of that is because of the J curve. That's why we're trying to find funds that can help mitigate that J curve. We did one a couple of years ago that actually drew a lot of capital that helped offset that this time, the Bain Special Situations Fund. But that is the concern going forward with the sizable commitments that we've made over the last few years, that there will be a J curve effect, and that since inception could potentially go down in the near term.
Understood. That's helpful to understand. Thank you. Okay, let's move on. Thank you for that report. Let's move on to our New Mexico private equity PMR.
So referring to page 126, I'll let Richard run the show here.
Thank you, Mr. Chair. I'm going to start on page 179, where we show the Horizon performance on the IRRs. And the next New Mexico program's performance was down 3.8% this quarter. I mean, it was similar to last quarter, which was down also 3.6%. It's really the same themes that we've been discussing in the last quarterly reports, where we had further write-downs in the Sun Mountain managed co-investment funds, which you can see on this page. I mean, there's still a large portion of the program's net asset value at 29%. And these funds are less diversified, so any movement in one company can have an outsized influence positively or negatively on performance. And when you look at the longer term performance on the since inception side, there's really been positive performance from every type of investment except the co-investment funds, which You do have the largest influence right now from the newer fund commitments, which has a net gain of 35 million, followed by the recovery fund. And I like to talk about the progress that we've made with diversifying the portfolio, because it does take time to change a private equity portfolio. You can't just hire a transition manager and move the assets. But as of the end of 2018, 75% of the net asset value was with one manager, and now it's 20%. Three companies accounted for 76% of the value, and now that's down to 24%. And we hope that this will continue to be diversified as new commitments draw more capital. Moving to page 180, the net asset value actually increased by 31 million during the quarter. And on 181 gives the details behind that. Despite the loss, we had a number of capital calls that came through that really drove up that net asset value, even though we did have a loss in the program. The co-investment funds lost about $19 million, but you can see here that the fund investments had net gains that slightly offset that. In 2024 for cash flows, we ended up having a net contribution of 122 million. So not as many distributions in this program as we saw in the national program, but we are seeing a lot more contributions given the commitment activity that we've done. And moving to 182, I mean, this is a dual purpose, sorry, 183. This is a dual purpose program. So, you know, we not only look at financial performance, but we also look at economic development performance. And so from a company perspective, we have 126 companies that have received New Mexico investment. That number is the same as it was last quarter. But you know, we continue to see a lot of the funds in the program look for New Mexico companies. And 8 companies received investments over the last 12 months, which shows kind of the activity that we were seeing from the underlying managers. Those funds that are in the program have invested 550 million into New Mexico-based companies. And then at the SIC level, so the actual capital going in from the SIC is almost 390 million. So if you were a portion of a fund, other capital is going into the New Mexico company as well. So you're able to leverage your dollars somewhat. The next page shows the job numbers, which really didn't change quarter over quarter. The jobs reported across all companies, 5,316, and the active companies, about 2,900. Job growth, which is comparing the job number now to what it was when they first made the investment, is 2,647. And then you have the annualized New Mexico payroll and annualized expenditures on New Mexico goods and services, which are similar numbers right now at 232 billion. So I'll conclude my remarks there on the New Mexico program and happy to answer any questions that the council has.
Any questions on the New Mexico private equity PMR? Hearing none, thank you very much. We'll now move on to item 3, investment matters, and I will recognize myself for the investment committee report. We had a good investment committee meeting last week. Madam Treasurer, thank you for joining us. We also have member Tejas, member Mary Roman, and member John Ulrich, advisory members on that committee. So we did have a quorum throughout the meeting. We unanimously recommended each of the voting items you see before you today. Advisory member Roman did pass on the final item, 3J, because she had not been able to attend the prior meeting where we kind of went through the overview of that strategy. But we still had a quorum to pass a unanimous recommendation on that matter, that item as well. So with that, I'd like to turn to item 3B, Silver Rock co-investment with Director Lofton and Makita.
Thank you again, Mr. Chair. This is working again. So we have our public speaking meeting next month. We should probably start with microphone management. So I believe we're starting on page 207 of your materials. Joining me on this presentation is Mary Bates from Makita, and online we should have Andrea Boyke, the partner with Silver Rock Capital Partners. Andrea, are you with us?
I am, and Vinay Kumar is also with us.
Wonderful, thank you. As Andrea mentioned, Vinay Kumar, he's head of their private credit. Frankly, the reason Silver Rock is not here in person today, it would have been pretty difficult given their travel plans. I gave them leave to join remotely, so that was my decision in case the council is curious about that. Just before we go into the recommendation, just wanted to note that the private credit program is seeking to expand co-investments in the private debt area to achieve primarily reduced fees and on the margin improve our capital deployment. With Silver Rock, we do have a unique opportunity to do that with an existing general partner. I want to highlight that it is unique because co-investments are typically done at the time of the main fund commitment instead of separately and as part of the negotiation with the GP. And frankly, we appreciate that Silver Rock is offering this co-investment capacity at this time as just a part of the broader relationship. And we think that the structure that they're offering is given the characteristics that we're prioritizing for our co-investments, we think that their co-investment vehicle is a really good fit. So with that said, SIC staff in consultation with Nikita is recommending a commitment of up to $100 million to Silver Rock Lobo Fund Class B co-investment vehicle. And just for some background on the relationship, the main strategy here that this is a co-investment on that the council has previously, Nikita's previously due diligence, the council has previously approved. SIC committed to and invest in the Silver Rock tactical allocation strategy through a fund of one structure. As you heard, that fund of one is called the Lobo Fund. The SIC approved an initial commitment of up to $300 million to this strategy back in April 2023. In March 2024, in recognition of SIC's expanding assets under management, the SIC approved an additional $150 million. So to the main fund, the SIC's total commitment is $450 million. This would be a $100 million commitment to the co-invest fund. With that, I'm going to turn it over to Mary.
Great. Thank you, Tom, and thank you to the trustees. So New Mexico SIC is currently invested with Silver Rock Capital Partners, as Tom already mentioned. The GP manages an opportunistic corporate lending strategy that is focused on capital solutions. As a brief reminder, the strategy invests across the credit cycle with a focus on taking top of the capital structure risk. No fund level leverage is utilized, and the strategy targets a net IRR of 12 to 15%. A few details as it relates to the co-investment. This co-investment is being offered on a no fee basis, so no management fee or no carry. This co-investment investment represents overflow investments, meaning the GP is already investing in these on your behalf in the core fund or the core sleeve. Again, you do have a fund of one, the Lobo Fund, that you're investing with them. So only overflow investments are eligible for this. As already mentioned, New Mexico has a fund of one with Silver Rock, and the vehicle is in place such that moving forward, this should mean effectively de minimis or potentially no additional operating costs as it relates to this sleeve, which we think is absolutely critical to highlight. Additionally, the GP will retain discretion as it relates to the co-investments. And also the GP has put in place what we view to be prudent diversification limits, looking at the co-investments across the co-investment sleeve, which Tom has already alluded to is sleeve B. And they're managing the co-investments across both sleeve B as well as sleeve A, which is effectively the core vehicle that is in the Lobo Fund, the Fund of One. So with that, happy to address any questions, or Silver Rock can, I'm sure they have some comments that they'd like to make as well.
I'd like to ask Silver Rock to make some brief remarks and then open it up for questions, please.
Perfect. Thank you very much. I should note that Bridget McKenna, who leads our investor relations, is also joining us this morning. We thank you for your time, and we are really delighted to have the opportunity to broaden our relationship with New Mexico State Investment Council and offer this co-investment capacity in the opportunistic private credit investments of the Silver Rock Tactical Allocation Strategy. We've been managing these types of investments since 2010, have more than 10 billion under management, and historically about a third of our opportunistic private credit investments have had capacity for co-investments. And again, as Mary and Tom had noted, would be excess capacity in the specific investments that are within the strategy. And again, that excess capacity, additional exposure would be offered on a no fee, no carry basis, and in accordance with the strategy, and most importantly, within the existing vehicle, so as not to incur any additional expense or a separate vehicle structure. So I'll conclude my comments there. We're again happy to answer any specific questions that you may have that the trustees may like to ask us.
Any questions related to Silver Rock co-investment?
Mr. Chairman,
Treasurer.
just one question. Can you just tell us a little bit, as a reminder, when we did the first deal, a little bit about your company, your fund? You're minority owned, right? Business owned?
I'm sorry, I just want to make sure that I heard you correctly. We are a women and minority owned firm. We're quite proud of that. We appreciated your question at one of our last presentations, because we do feel we've hired the best people, and hopefully the returns that we've generated for you being, within our targeted range of 12 to 15% would suggest that as well. We are about 51% invested thus far across the exposure that we have currently. And of the 19 investments that we've made, 5 of them would have had co-investment exposure. So just under 30% of the portfolio were we to have had this co-investment program in place from the beginning. So we're excited about the opportunities as we think going forward. Vinay is the managing partner and leads that investment effort. And if it pleases you, he's happy to touch on where we see opportunities as we move forward into this upcoming year.
Mr. Chairman, based on the recommendation of the Council's Investment Committee, Advisor Makita, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve a commitment of up to $100 million to Silver Rock Lobo Fund Class B co-investment vehicle, as discussed and memorialized today by the Council, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
We have a motion by the treasurer. Is there a second?
Second, Nick.
Second by Member Tejas. Any discussion on the motion? We take a roll call vote, please.
Treasurer Laura Montoya,
Yes, and explain my vote.
DFA Secretary Wayne Props,
Yes.
Nick Tass,
Yes.
Catherine Allen,
Yes.
John Bigeman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer,
Yes.
and I'm sorry, Treasurer Montoya, did you have something?
Yes. You finished your vote?
Yes.
Okay, perfect. So I just wanted to say, normally I would be very concerned with this much money going into one fund, but we've done so much research on it. And this costs nothing more for us. This is a great relationship to continue. And I have to admit that I'm really excited because this council put in their vision and their mission statement about diversifying the portfolio, which I think is what we actually have been doing quite significantly this last year. But this particular fund, the fact that it's women-owned and minority-owned just gives me a little bit more excitement that I just had to express publicly to all of you. So thank you guys very much.
Thank you, Madam Treasurer. Thank you very much to Silver Rock for joining us today. And let's move on to item 3C, Castle Lake
Thank you.
ABC
Thank you.
3. Thank you.
Okay, thank you, Mr. Chair. I believe we're on page 216, book 1 of your materials. With me again, Mary Bates from Nikita. And then we have Evan Brothers, who's the chairman for Castle Lake. We have Betsy Sylvester, who's essentially our relationship manager. And then we have Matt Little, as partner, head of capital formation for Castle Lake as well. Betsy leads business development. She's more than just our primary point of contact. She's my primary point of contact, so that's awesome. Thank you. Sorry about that.
No problem.
So with that, SIC staff, in consultation with Nikita, recommends a commitment of up to $250 million to Castle Lake asset-based private credit 3 Evergreen, APC 3E, that we're going to call it, is managed by Castle Lake. It is an asset-based financing strategy. As we've said repeatedly, asset-based strategies provide meaningful diversification from corporate lending. With that said, I want to highlight that the APC 3E structure is evergreen, meaning it does not have a fixed termination date. And I think at the credit committee, I think it may have been Chairman Bingham who mentioned the liquidity there. So investors may request redemptions on a quarterly basis after a 1-year lockup period. So even though it is evergreen, there is a liquidity option. As we mentioned for the priorities of the program, they also offer a reinvestment option, which we are also choosing there as well. Given some of the feedback from council members at the credit committee regarding Castle Lake's relationship with Brookfield, Mr. Carruthers, who's the chairman for Castle Lake, thought it would be prudent to be on site here to answer any questions along those lines. And just for background for the total relationship for the council. Brookfield Asset Management owns 51% of Castle Lake, with an option to acquire the remainder. Brookfield also owns Oak Tree Capital Management, which Oak Tree has a very large firm, I think over $200 billion under management. SIC, the council, has historical and current active investments and active commitments with both Brookfield and Oak Tree. Total commitments would be close to $2 billion. The actual net asset value of the current value plus any remaining potential calls of our capital would be about $1.3 billion. If you combined everything in policy, the council has a 10% maximum exposure to any one GP and its affiliates. So we're at $50 billion. We're well under that. And in fact, the combined exposure would still not be in the top 5 credit exposures. So with that, I'm going to turn it over to Mary.
Great, thank you. Thank you, Tom. So consistent with how we presented the performance report, really one of the key areas of focus for this year is in the asset-based the asset-based credit space, and this is a manager that is focused on that area. So this strategy is focused on income-oriented loans. The fund allocates roughly 45% to specialty finance, 45% to real assets, and 10% to aviation. And I'll let the GP to go into detail around that. The strategy is targeting an IRR of 10 to 12% net. So consistent with how we typically walk through our part of the presentation, I'd like to highlight for the committee really the strengths and the potential concerns and associated mitigants that we've identified while underwriting this investment. So from a strengths perspective, we identify Castlelake as one of the most experienced and largest private asset-backed specialists in the market. They have over 20 years of experience in this space, 30 years if you include the time of the founders at their inclusive of their tenure at Carval, which is where they came out of. The firm has committed nearly $50 million, $49 billion, excuse me, in asset-based private credit since their inception, making them one of the largest, again, specialists in this area. And why we think that's so important is because asset-based finance is a highly specialized and nuanced area. So it's very, very important to be proficient in the structuring, the underwriting of these highly bespoke opportunities, as well as to have the relationships in place. So sourcing opportunities in asset-based private credit is quite different than it is in the private credit space. So all of that time and experience we think is very, very, very important. We would also highlight one of the things that we identify as a strength as it relates to this strategy is the overall, what we would describe as a conservative risk profile. And what we mean by that is this manager focuses predominantly on lending to mature, stable companies. The average age of the operating companies that they're lending to, at a high level, you can think of this strategy as lending to lenders. They make loans to specialty finance companies, and the average age of the company that they're making loans to is 13 years. So these very, very well-established companies, a highly, highly diversified portfolio. Think of this as 50 to 60 transactions with, I believe, over 2 million underlying loans. So incredibly, incredibly diversified. Also, these loans generally self-amortize, which means that they pay back both the principal as well as the income of the investment over its life, and they're typically fairly short dated. What that means is, in comparison to a corporate loan, as a comparison to a loan in the middle market direct lending space, which often is monetized or exited, liquidated through refinancing, here, one of the things that we take a lot of confidence in is they just get their money back. So there's no need to go out to the capital markets. So we think that's important. Also, this strategy doesn't do things like royalties and other strategies that are dependent on what's called the residual value when you're underwriting an investment. So all of those things give us a lot of comfort, as well as the manager's track record. And they've had no losses at the project level. All of these investments are underwritten so that there is an expectation in terms of loss adjusted yields, and I'll let the manager talk about this, but they have no losses at the project level. So they really have delivered on what they've said that they would do. I've already highlighted this. This manager is really recognized in the industry for their expertise, particularly in the real asset space. And so it's, I would say, hard to replicate the platforms and the origination platforms that and the joint venture partnerships that they have in place. But they've also been very, I think, prudent in terms of putting together kind of a hybrid model where they own some origination models in-house, but then they also joint venture with external partners. So they can kind of express relative value, but then also have some of the benefits of owning some platforms. Tom alluded to the last point. One of the things that we like about this strategy, in particular for New Mexico, is they do offer an evergreen vehicle. And with that evergreen vehicle, what they offer as well is the option to recycle your income. Again, because you're in a highly cash flow positive situation, you're in the enviable position of having a lot of cash so you don't necessarily want to get it back. You want to reinvest it, particularly, in a higher yielding strategy, and you have the option to do that. So all of those things we view as positives. On the flip side, as with any investment, there obviously are concerns. We've already referenced, we have a preference for managers being privately owned. That's just, a preference of ours. But we recognize that private credit, the industry is maturing, and that creates needs in terms of balance sheet recapitalization. So from our seat, we view it as a mitigant, actually, that Brookfield is the partner that they have, is the manager that they've opted to partner with. We also think, and Evan can go into as much detail as you'd like around this, they've been very thoughtful in terms of how they've structured the deal so that the Castle Lake team has retained all of the operating and investment controls over that, which gives us a lot of comfort. And we've also seen Brookfield take a very hands-off approach to the investment managers that they've worked with. So from our seat, we think if anything, kind of the transaction that they did last year took some uncertainty off the table. So net, we view that actually as a positive. One of the things we would highlight, we appreciate that we're in executive session, so we won't go into great detail in terms of the fees, but one of the things with but with most evergreen funds is you do have incentive fees being crystallized annually. And that's just not something that we prefer. We view that as more GP friendly rather than LP friendly. That kind of is the world how it works in evergreen funds. Why we're comfortable with that? We're not comfortable with that for all funds. Why we're comfortable with that for this fund is because this should be a fairly stable return. So meaning if you had a lot of mark-to-market volatility, then we wouldn't want to, and we wouldn't bring you a fund where incentive fees are crystallized annually. Here, because this is an income-oriented fund that should have fairly consistent returns over time, we're comfortable bringing that to you. And the manager also has a clawback that they can go into. The last thing we'd highlight for you is the manager has had some turnover and probably a higher level of turnover than some of their peers. We would and we spent quite a bit of time with them, better understanding that when we were going through our due diligence process. And obviously, I'm sure that they'd be happy to explain it in greater depth. But what we took comfort in is the fact that the departure is really tied to a strategy that the GP is moving away from. So they moved away from a more opportunistic, kind of higher octane type of strategy, and are focusing the majority of their attention on this more income-focused strategy. And I can tell you from my seat, I focus on private credit. I don't think I'd be very good at focusing on private equity. It's just a very different mindset. And so it's not surprising that you see turnover when you see that type of pivot from the GP. So none of the departures tied to this strategy. So all of those things give us some comfort. So with that, I'm happy to take questions or happy to turn it over to the GP.
And I want to interrupt just real quick for clarity. Thank you, Evan, for pointing this out. This is a commitment of up to $300 million.
Thank you. And I think we'd like to recognize the GP to make some brief remarks and then move to questions, please.
Sure. Can everyone hear? Okay. Thank you very much for having us. My name is Betsy Sylvester. As Tom and Mary noted, I am Managing Director and Head of Client Management at Castle Lake. I am joined by Matt Little, who is Partner and Head of Capital Formation, and Evan Carruthers, our Chief Investment Officer and Chief Executive Officer. As Tom noted, Matt and I will be primary contacts for the New Mexico team going forward.
As Betsy mentioned, we'll be the primary contacts. One of the things that we thought might be important to mention is that through the APC series of funds, we do actually lend money into the state of New Mexico and have lent approximately $20 million to the state of New Mexico through our APC series. With that, I want to hand it over to our co-founder and CEO, Evan Carruthers, to talk about the firm.
Great. Well, wanted to start by thanking the council for allowing us to present. My name is Evan Carruthers. I'm the CEO of Castle Lake. I thought what I could do is just briefly give an overview of the organization and then dive more specifically into our core asset-based lending strategy. Our organization is Castle Lake. As Tom had mentioned, we're in our 20th year of existence. We were founded by myself and my partner, Rory O'Neill. Really, when you think about our organization, we are not a broadly diversified credit manager. We are a specific manager that focuses on asset-based credit. We either will buy assets or we will lend against assets, and we devise investment strategies that focus on that asset orientation and that asset market, which we would view as our value add and our core competency as a GP. We manage about $25 billion of client capital today. That's across about 250 institutional LP relationships. That is managed by a group of about 225 individuals scattered around the world. We do execute on this asset-based lending strategy on a global basis. With the global mandate, we have a global office presence as well. We've got 3 offices in North America, and we've got 4 offices across Europe and the Asian markets as well. Tom and Mary mentioned that we did sell a stake in our firm last year to Brookfield Asset Management. For those that are less familiar with Brookfield, they're about $1 trillion asset manager. I think they're probably considered the largest asset-based investor globally. I think there was some sort of institutional logic behind that acquisition. I think what was important to me as one of the founding partners of the organization is as a part of that transaction, we specifically designed it to make sure that we would operate independent of Brookfield on a go-forward basis. They bought 51% of our organization, but they do not have governance control over our firm, nor do they have managerial control over our firm. We view asset-based investing and asset-based lending as being a specialized competency. That is really our value add to our clients. We did not want an acquisition to in any way impair our ability to make investment decisions, drive our overall firm direction or strategy. We were able to accomplish that through the structuring of the Brookfield transaction. We're thrilled with the partnership. It was very much a recapitalization of our balance sheet. When we sold a stake in our firm, we did not take money off the table. It's actually designed to reinvest back into our funds and really facilitate future growth of the organization. With that, I'll transition a bit to our core strategy, which is this asset-based lending strategy. When you think about asset-based lending as a strategy, asset markets are about a $30 trillion market. We do not do everything in the asset-based arena. Our core competency is, and this is on page 281 of your deck. We will focus on lending against financial assets. You can think about those assets as pools of consumer receivables or small business loans. We will carry that through to traditional hard asset investing, things like aircraft, yellow metal, or other forms of equipment leasing that would be traditional, hard asset lending strategies. That addressable market for us is about a $7 trillion market. You can think about our lending strategy as very much being kind of a Main Street lending strategy, focused on, I would say, some of the biggest opportunity sets from a credit perspective around the world. One of the reasons why we have always focused on asset-based investing is, a couple of reasons. First and foremost, post the global financial crisis, there has been a consistent trend where banks have been pulling back from asset-based lending. I would say that started in the corporate direct lending markets, and then it navigated its way into asset-based lending. So banks continue to retrench. And I think a part of what alternative capital is doing is forming around that opportunity set to really fill that capital void. But when you look at the asset-based markets, we view them as being significantly underpenetrated by alternative capital. So I referenced our addressable market being about a $7 trillion marketplace. It's only about 5% penetrated by alternative capital. So you've got banks retrenching, you have a significant capital need to provide credit to a lot of these Main Street industries and asset classes, but alternative capital has been slow to form around this asset class, which we view as, key criteria when you think about getting your capital exposed to these lending markets. You want to focus on undercapitalized markets where you do not have that capital saturation. So it's one of the reasons why we're a pure play asset-based investor, but it's also one of the reasons why we're so passionate about the opportunity set that's in front of us today. So the core of our asset-based lending strategy is designed to deliver back to the LP low net double-digit rates of return. So typically we're in the 10 to 12% return thresholds for these funds. If you look at our asset-based lending vehicles, we have a long-standing track record in this space. We have delivered sort of to the top end of that range, about a net 12% rate of return. But I would say equally important, beyond just baseline IRRs, is we've been able to do that with significant risk control. So we have not suffered a realized loss in that strategy across billions and billions of dollars invested, which really I think is a testament to the attractiveness of asset-based investing. You're collateralized by either a pool of financial assets or a hard asset itself. And then I think one of the big differences between asset-based lending and, for example, corporate lending is we typically will benefit from not only higher coupons and higher excess spread, but equally important, heavy amounts of amortization. And so we call that a self-liquidating strategy. We get our basis paid down early, which is a key risk mitigant if you think about the risk of recession or volatility in the marketplace. We want our basis de-risked, and then we want the benefit of being collateralized by that hard asset or that pool of financial assets. In the combination of high cash flow in that asset orientation, ultimately, we believe drives that risk control on a go-forward basis. So we've been pleased with our performance historically. And for a lot of our clients that invest in our funds, I think we provide natural diversification away from corporate lending into a lot of these specialized asset classes, which are very much underpenetrated by capital in the marketplace today. So you can see our track record on page 284 of the deck. And with that, I'm happy to open it up to questions.
Thank you very much for being here with us today. Any questions for AP Castle Lake from the council? Hearing none, is there a motion? Good. Okay, I will go ahead and make this motion. Based on the recommendations of the Council Investment Committee, Advisor Makita, RVK, and SIC staff, I move that the State Investment Council approve a commitment of up to $300 million to Castle Lake Asset-Based Private Credit 3 Evergreen, as discussed and memorialized today by the Council, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I second.
The second from Member Allen. Any discussion on the motion? Take a roll call vote, please.
Treasurer Laura Montoya,
No.
DFA Secretary Wayne Props,
Yes. Yes.
Nick Tejas, Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Sommer.
Yes.
It's,
Mr. Chair, this is Nick. I'd like to vote yes.
Thank you, Nick. That is 7 in the affirmative, motion passes.
Thank you very much. Appreciate you being here with us today. Let's move on to item 3D, Arcline Capital Partners 4, Director Cassidy and Mercer.
The materials for this investment start on page 293. We're recommending a commitment of up to $100 million to Arcline Capital Partners 4. This is a middle market buyout fund focused on investing and building what Arcline refers to as best-in-class industrial compounders, and I'll let the manager talk to that when they speak rather than me doing that. This is a really differentiated strategy in the buyout space. As a manager you've gotten to know over the last year, they have a really great LP base, more skewed towards private endowments and foundations, and longer term, we're trying to build more of an endowment-like portfolio in the private equity portfolio. I'll pass along to Amy to talk about the due diligence that Mercer did on Arcline.
Great, thank you. So Arcline Capital 4, this will be a new relationship for the SIC. It will fall into the buyout category of your portfolio. Our report starts on page 307. So this firm started in 2018. It was actually a spin out. The co-founders previously worked together at another private equity firm called Golden Gate Capital. And so they have been investing together for about 16 years. So we like to see that even pre this firm, they had an experience of working together. And they have a really unique organizational structure that we think really supports the strategy that they're executing. They actually have 4 different distinct teams within Arcline. They have a business development team that's solely focused on sourcing, being out in the market and sourcing proprietary and best ideas. They have a research team that identifies trends, market trends within the portfolio companies. They have a research or a underwriting team, which actually just does all of the due diligence and screening of opportunities. And then they have a strategy, talent, and ops team they call the STO team that focuses on value creation post-investment. So we think that that's really additive to this strategy. There is some key person risk around the CEO, Rajiv Amara. We did a lot of reference calls and a lot of discussions in the market. He's very pivotal to the strategy and the firm, the culture. So we do appreciate that there is a single person, key person trigger around him because he is very central to this firm. The strategy focuses on U.S. companies with high growth potential from recurring revenue and margin enhancements. I would point out this is going to be a more concentrated portfolio. That's one of the strategy changes that we have seen since their first and second funds. Beginning in Fund 3, they are concentrating on acquiring larger platforms and having a more concentrated portfolio of 5 to 7 companies. We did get comfortable around that because they do a lot of add-on acquisitions. So you get a lot of diversification in the underlying portfolio companies. They're doing 10 plus acquisitions at that underlying portfolio company level. So we did get comfortable with that as well. And then if you go to page 323, for their performance, they have had very strong performance over the 3 funds that they have raised, generally top quartile performance. They don't have a lot of distributions or full realizations yet, but that's expected with the age of the track record. They started their first fund was a 2019 vintage year fund. So since there wasn't as many full realizations looked at, we spent a lot of time understanding the operating growth and metrics and successful add-on acquisitions in the underlying portfolio companies and got comfortable that they are able to execute and build the value that they have stated as part of their strategy. And finally, their terms are generally in line with market. I would note they do have an above average GP commitment, which does provide good alignment with limited partners. So we are recommending up to $100 million commitment to Arcline Capital Partners 4. And I would like to turn over to co-founder and CEO Rajiv Amara, who I believe has joined us over Zoom.
Yes, I'm on. So good morning, everyone. Thank you for the opportunity to discuss Arcline with you today. Before I start, we must say we've had a great experience with Mercer, Chris, and the rest of the investment team over the past several months. We don't have many pension funds in our investor base, and I would say the diligence has been extremely thoughtful and thorough as anything we've ever seen. I'm Rajiv Amara, the CEO and founder of Arcline Investment Management. I've been in the private equity industry for around 25 years. I spent the first 18 years at my prior firm, Golden Gate Capital, investing in industrials and software businesses. In 2018, I left my predecessor firm to start an industrials-only focused investment firm, Arcline. It's not a generalist firm. We only focus on one thing, which is building these best-in-class industrial compounders. And in just 6 years, we've grown to over 50 professionals, and we've got about $9 billion under management. We are based in Nashville with offices in San Francisco and New York. I will say our culture is unique. We have Mercer mentioned, our culture is really functional work structure, and our culture is centered around delivering results for our investors. If you could go to the next page. In preparing for this meeting, I spent a lot of time looking at your 2025 annual investment plan over the last week, and I will say it mirrors a lot of my outlook. You have a cautious outlook, lower growth and higher inflation over the next 7 to 10 years. And I believe just building a diversified, durable portfolio to thrive during this time horizon aligns perfectly with what we are doing at Arcline. We target 20% IRRs over the long term through a strategy of building these compounders. I would say the industrial compounder category is not as well known as the Mag 7 category, but these are really resilient businesses. They are characterized by strong business models. They sell a diverse array of high cost of failure products into life critical end markets, which mitigates the risk of technology disruption and macro volatility. Their products go into these very long-lived platforms that sometimes provide decades of recurring revenue. In addition, these industrial compounders also participate in regulated industries, and these regulated industries usually have very high barriers to entry. And we always believe that this blend of stability and just measured growth make these industrial compounders more dependable long-term investments in this complicated, changing world. And we have a three-pronged value creation playbook. First, we focus on operational discipline. We tightly manage costs and enhance productivity in all of our businesses. Second, we aggressively pursue strategic acquisitions. And then third, we leverage our commercial expertise to drive revenue growth. And with this playbook, our objective is to target about 15% profit growth a year, which we've been successful in doing. I would say investing in industrial compounders also further diversifies portfolios away from all of the inadvertent technology concentration. In your 2025 outlook, there was reference to the Mag 7, which is well over 30% of the S&P today. I will say the industrial compounder asset class is a asset class that has consistently beat the S&P over the past 25 years, but it still only accounts for less than 1% of the S&P 500. And I believe with our experience and focus, we are really well positioned to add the diversification and, more importantly, the stability to your portfolio in these uncertain times. So thank you very much for your partnership.
Thank you very much for those remarks. Do we have any questions for the GP? Do we have a motion?
Yes. Based on the recommendation of the Council Investment Committee, Advisor Mercer, SIC staff, and general fiduciary oversight from RBK, I move that the State Investment Council approve a commitment of up to $100 million to Arcline Capital Partners 4 LP, subject to the contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you very much. Motion by Member Sanchez. The
Second by
was
Member Summer.
Member Summer. Can we, any discussion on the motion? Can we take a roll call vote, please?
Treasurer Laura Montoya. DFA Secretary Wayne Props.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes.
That's 7 in the affirmative. Motion passes.
Thank you very much.
Thank you.
Thank you. Let's now move to item 3E, Bain Capital Fund 14.
The materials for this investment start on page 357. Bain Capital 14 is a re-up. We're recommending up to 150 million to the fund. It's Bain's flagship fund, focused primarily on North America and selectively in other parts of the world in conjunction with Bain's Asian and European funds. In addition, we're recommending up to $300 million side-by-side co-invest SMA that will invest across the Bain private equity platform. If you go to page 359, we put a chart in there that discusses how Bain organizes its private equity and sector-focused funds. We're invested across 6 of them. We'd note that, how they raise capital reflects limited partner feedback. Some groups, for example, raise global private equity funds that would collapse the North America, Asia, and Europe into one fund. Bain's limited partners have asked them to raise 3 separate funds. So I think the number seems, higher, but just depends on each firm and their limited partners and what they want. But the 300 million would co-invest across those 6 private equity funds, the 3 regional funds, as well as the 3 sector-focused funds. And last year, if you recall, we invested in their Global Special Situations platform, which is a separate group within Bain. And also, as part of that, created a co-invest vehicle with them as well. In terms of the overall Bain relationship, we view it as a core position. And in our view, one of the core requirements for groups where you have a larger position in is alignment. And this is really where groups like Bain really shine. This has remained and is committed to being a classic partnership with no outside ownership. They have a broad distribution of economics in the firm among their team. And they have very, very large GP commitments that aligns, their interests with limited partners like the SIC. And so, similar to a group like TA, which are currently our 2 largest exposures, these are both groups in that category. In terms of large cap buyout exposure, the portfolios, particularly recently, the commitments have been geared towards middle market. Of the 2 Bain funds we're bringing today, Bain Insurance is a lower middle market strategy effectively, and Bain 14 is a more of a large cap strategy, although not exclusively. We do think there's groups in the large cap space that can add value to companies and earn great returns, and we think Bain's one of those groups. On the co-investment side, this is a journey we've been talking to you about the last year. We started it with the creation of a SMA with Mercer to invest opportunistically in co-invest that became available across the manager set in our portfolio. This would be the 6th side-by-side co-invest vehicle that we'd set up with a manager, 2 of which have been with Bain. In addition, Bain has already been providing us good co-invest opportunities. 2 of the 7 investments that we've made in the Mercer SMA were at roughly 89 million of total commitments so far. And 2 of those were with Bain Insurance. We have more detail on that on page 448 if you're interested in seeing the detail on that. The final thing I'll mention, and this is a little unique to Bain, Bain provides 2 share classes, which basically give LPs the opportunity to choose basically the journey, the path of how fees are paid. As we discussed last year, we increasingly, as we ramp the portfolio, intend to recommend share classes of lower management fees in order to reduce the J curve as it ramps, particularly for groups like Bain 14. Bain is one of the most methodical groups in terms of time diversification. They deploy over 3.5 to 4 years. So particularly in the early years, when the unfunded commitment is out there, the lower management fee helps reduce the J curve. We put in both the memo for Bain 14 and Bain Insurance, we put tables in there that Bain provided us, which shows scenario analysis depending on the gross returns and average holding period. The one for Bain 14 is on page 362. And again, you get roughly to the same place. The path is just different. And as we're having such a large ramp in our portfolio, that won't matter over the next 3 to 5 years, given the unfunded commitments in the portfolio will increase, would also be helped by co-invest. So I'll pass it on to Richard to talk about their due diligence.
Thanks, Chris. Thanks, Mr. Chair. We do have 2 re-ups for Bain Capital Funds today. This is the first one, Bain Capital Fund 14. So far, Bain's been a strong relationship in the national program with a net IRR of 26% and multiple of 1.2x as of September 30th, 2024. The SIC previously committed $50 million to the predecessor fund, Bain Capital Fund 13, and we're looking to commit up to $150 million to Bain Capital Fund 14. So this fund is Bain's large buyout fund that focuses mostly on North America-based investments. The firm has a large and established team with its 2 co-heads, Chris Gordon and David Humphrey, who we have here today, having been at Bain for more than 22 years each. We also have 22 partners in the group who average over 15 years at Bain. And the team has over 122 investment professionals, but Bain is a global platform, so they can also leverage those in other groups as well as needed, such as the private equity teams in Europe and Asia. Bain's buyout strategy really focuses on a variety of industries and has good diversification, including industrial, consumer, healthcare, financial and business services, and technology. I think a key part of Bain's investment strategy is really to focus on improving companies through several value creation initiatives. And this is supported by a portfolio group, which has almost 30 individuals dedicated to the Bain Large Buyout Fund. With these resources, they can target more complex situations that others might shy away from. We also like that they've been more measured in their capital deployment than some other private equity firms, where they typically deploy a fund over 3.5 to 4 years. They weren't tempted by the increase in private equity investing in 2020, 2021, where we saw a lot of funds actually rapidly deploy their fund and then be back in the market. When you look at the track record, it has been mixed. On a historical basis, Bain has had some underperforming funds from 2006 to 2008, but they have made process improvements to improve the buyout strategy, and we've seen performance improve. We've also seen more discipline in their investment strategy, which gives us comfort going forward. A key hallmark of Bain's funds are strong alignment. They're usually the largest investor in their funds, and this fund has a large general partner commitment as well. And as you've seen, just a quick mention about the separate account. We've been doing separate accounts alongside larger managers to help lower the cost and make private equity investing more efficient for the overall portfolio. And so this sidecar is a no management fee, no carry basis. And basically what it does is it lowers the overall cost of both the Bain relationship and then also the overall portfolio. And this one is somewhat unique to the other ones you've seen because it'll actually invest across the other private equity funds that have been approved by the State Investment Council. So not just the Bain North America Buyout Fund. So with that, we're recommending an up to $150 million commitment to Bain Capital Fund 14 and $300 million to the co-investment separate account. I'll turn it over to Dave.
Great. Mr. Chairman and the Council, thank you very much for it.
And if you sit back a bit from the mic, it tends to work a bit better, perhaps.
Is that better? Is it working? Yes.
Are those on the phone able to hear?
It's a little low.
Good. I guess you might have to sit back and speak up. Apologies.
Okay. I'll do my best. Can you hear me better now?
Yes, thank you.
Yes. Okay. Mr. Chairman of the council, thank you very much for having me here. Also, thank you very much just for your, past investments and commitments to our investing platform. We take very seriously our obligation every day to try and drive very good investment returns for you. I'll just start just a brief personal introduction and then just share four elements of our firm, and happy to take any questions. My name is Dave Humphrey. I'm a partner at Bain Capital. I've been with the firm for 24 years. I joined in 2001. As Richard was saying, I co-lead our North American private equity business and also lead our technology sector. I'll just describe four, brief elements of our approach to North American private equity for you. The first is just some more color on our history and our sort of founding principles. Second is our value creation efforts and therefore the types of investments we try and make. The third is just to touch a little more on our alignment and our approach there, which you've heard about already. And then finally to comment on our results. So our history, we were founded now 41 years ago in 1984 with the notion that we were a friendly spin-out of Bain & Company, a strategy consulting firm. And the basic approach is that if we were good at advising and supporting businesses, we should invest behind those businesses, in particular focus on businesses that are high quality in terms of value proposition to their customers, in terms of their competitive position, and where we could help to inflect the operations of those businesses through further growth by lending our human capital as well as, of course, our financial capital to support the growth of those companies. And that if we got those questions right, the financial returns would follow. We've stuck true to that strategy over our 41-year history and have a deep focus on just continuing to learn and continuing to invest in our capabilities. So that takes me just to the second point, which are our value creation capabilities and efforts. And a few points I would leave you with. The first are that we have a large team. We have 120 investment professionals focused on North American private equity as a part of 360 investment professionals around the world. And in addition to a large team, a lot of longevity, as you heard about, and a different type of people than most of our peer firms and competitors, and that about 3/4 of our people have strategy consulting or operating backgrounds as opposed to just financial services backgrounds. And so that allows us to undertake a different type of investment where we can strive to generate upside returns through operating inflection with our businesses. I also want to comment on our alignment, as you heard. Since the founding of our firm, one of our core principles is a partnership, of course, with our limited partners, as well as with the management teams that we partner with, and a real belief that we should be, as a partner and employee group, our own largest investor in everything that we do. And so really the life savings of our people are invested right alongside you in all of our companies. At this point, about 15% of the capital that we're investing is the partners and employees' money at Bain Capital. A typical private equity firm, that number would be between 1% and 5% of capital. And that's important, of course, because it's a high degree of alignment. We are invested right alongside you and striving to make the right economic decisions for the long term that will create lasting value and create investment returns. Additionally, in terms of alignment, we are a privately owned partnership, and we have set ourselves up that there is no permanent shareholder of Bain Capital, including as partners retire, they contribute their economics back to the firm and to the generation of partners that are leading the investments that we are making. And we have no outside investor, whether the public or any private investor that holds any stake in Bain Capital. And therefore, the way our people are rewarded is, of course, through our personal investment, by and large. And as the results of our investments, bear economic rewards, those flow to the team that are driving those investments. And then as those partners retire, those economics are handed back, continually to the next. So just highly aligning with all of you. The last thing that I wanted just to comment on are our results. If you look over the course of our 41-year history, we have averaged a 2.9 times gross multiple of money, which is over a 2 times net, and 18% net IRRs. And those, as you heard Richard referring to, have been even stronger over the last 10 years. So over the last 10 years, we have averaged a 22% net IRR. The Fund 13 that you are invested in is a 2021 fund. We are about 90% invested in that fund. Thus, obviously, the conversation here about our Fund 14. We anticipate about one more investment in our Fund 13 before we start investing our Fund 14. Fund 13 is progressing very nicely. We invested over a 4-year period, and so is not overly allocated to either technology or 2021. The businesses are performing well. That fund saw carrying value increases of 20% each of the last couple of years. It is still in the early part of the fund, where we've deployed capital recently, and so is at a 9% net IRR as we sit today, but is tracking very closely to our Fund 12, which is at a 20% net IRR when you look at the progression of appreciation of the individual assets in that fund. So with that, I am happy to take any questions that you all have, and we appreciate your consideration.
Thank you very much for being here with us today and making that presentation.
My pleasure.
Do we have any questions for Bain Capital? I'd just like to note, I really appreciate the team, negotiating this co-investment. If we're successful deploying the full co-investment, I think that effectively means our fees and expenses related to the fund investment will decrease by about 2/3. So it's a really significant, opportunity for us, and appreciate you making that available.
And we appreciate you all considering it. It's economically attractive, hopefully, for you as you're trying to drive your net returns, and also, for us, allows us to have capital available to, if we see attractive larger investments that require some co-investments.
Fantastic. Is there a motion?
Mr. Chairman, based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and general fiduciary oversight by RVK, I move that the State Investment Council approve a commitment of up to $150 million to Bain Capital Fund 14 LP and up to $300 million to a side-by-side co-investment vehicle subject to the contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Motion by member Sanchez, a second by member Summer. Can we take any discussion on the motion? We have a roll call vote, please.
EFA Secretary Wayne Props,
Yes.
Nick Teas,
Yes. That's a yes for me.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
7 in the affirmative, motion passes.
Thank you again for being here.
Thank you very much.
Okay, let's please move to item 3F, Bain Capital Insurance Fund 2.
So this is the second investment from Bain. We're recommending up to $100 million to Bain Insurance Fund 2. This is a re-up. This is Bain's middle market buyout fund focused on insurance businesses across the value chain. Really want to compliment the team. This is honestly one of the most interesting funds in our portfolio. We're always quite interested in the deals they have. They're always unique and proprietary. I think when you hear insurance, you wonder if it's not as interesting or not as quote unquote sexy. But hats off to the team. They do a lot of very, very interesting stuff. I'll pass it on to Richard to discuss in more detail.
Thanks, Chris. Thanks, Mr. Chair. So Bain Capital Insurance Fund 2 is the second fund from the Insurance Solutions team, which is part of the broader Bain private equity platform. The SIC committed $60 million to the first fund. Bain's insurance team is led by 3 partners who have more than 25 years experience. Matt Popoli, who's the global head of Bain Capital Insurance, joined the firm in 2019 from Insurance Capital Group, and he also had experience as a partner at Reservoir Capital Group, where he led insurance investments. He's also joined by partner Matt Cannon, who's been at Bain for 13 years, and Ron McIntosh, who previously co-founded Lomas Capital, which was a hedge fund that was seeded by Reservoir Capital Group. The broader investment team has 17 members, 5 of whom are managing directors and partners. And they also have 7 dedicated portfolio group members. We talked a little bit about portfolio group in the first commitment, but having dedicated portfolio group members is a positive, we feel like, especially with the unique features of insurance companies. It's nice to have that operational expertise within the team. And just like the other Bain strategies, they can also utilize global resources as needed. And this strategy primarily focuses on controlled buyout investments in companies operating in the insurance industry based in North America and Europe. The team has a strong network of industry executives, and it's similar to other funds too. They're also comfortable in trying to source things away from competitive positions, with their network. And there's also a strong focus on building better companies, from their investments. Fund 1 is generating top quartile performance to date, although it's still relatively young. But, in looking at the underlying company fundamentals, it is performing very well. And the firm did have 2 pre-fund deals as well, which are performing quite well. And similar to other Bain funds, there is a large general partner commitment with this one as well, which is strong alignment with limited partners and between the general partner as well. And other terms are similar to the other Bain strategies. So we're recommending an up to $100 million commitment to Bain Capital Insurance Fund 2. And Mr. Chair, I'll turn it over to Matt for his presentation.
Thanks, Richard, and thanks, Chris. And thank you, Mr. Chair and trustees, for allowing me to address you today. I'm glad for the council. Can everyone hear me okay? Great. My name is Matt Popoli, and I'm a partner at the firm and global head of our insurance business. I have been invested in the insurance industry for 25 years. That's sort of all I've done for the last quarter decade as a professional. First, I'd like to thank the SIC team and trustees for supporting our inaugural fund, Vintage 21 fund, and appreciate the consideration of our second fund. I'll give a quick refresh of the strategy. It's fairly straightforward. We acquire and invest in businesses across the insurance value chain, primarily distribution businesses, insurance distribution businesses, and insurance services business in the lower middle market. We are value investors at heart and are very focused on attractive entry multiples. And we think that the team that we've built, that I'll speak to in a minute, allows us to go and source things on a differentiated basis. We believe that the insurance mid-market is attractive. It's quite large and not nearly as competitive as other parts of global private equity. And if we think about what we've done, we've built one of the largest teams within insurance. We've got now over 20 people, investors dedicated, as Richard was saying, both to making the investments and then to monitoring our investments and adding value over time. And we leverage our team's deep sourcing capabilities to really make investments outside of the competitive auction process. Quick note on Fund 1. So we are nearly 80% committed. Nearly all the deals have been sourced on a proprietary basis. This has allowed Fund 1 to have what we think are really attractive entry multiples, and expect that to continue across Fund 2, which will have the exact same strategy as Fund 1. Thank you again for your time today, and happy to answer any questions.
Thank you very much for your remarks and for being here today. Any questions from the council on Bain Capital Insurance Fund 2? Okay, hearing none. Do we have a motion?
Mr. Chairman, based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RVK, I move that State Investment Council approve a commitment of up to $100 million to Bain Capital Insurance Fund 2 LP, subject to and contingent upon New Mexico legal requirements New Mexico State Investment Council policies, negotiation of final terms, and conditions and completion of appropriate paperwork.
Motion by Member Sanchez. Do we have a second?
Second. Member Summer.
Second by Member Summer. Any discussion on the motion? Do we have a roll call vote, please?
CFA Secretary Wayne Props,
Yes.
Nick Tass,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
That's 7 in the affirmative, motion passes.
Thank you again.
Thank you.
Let's now move on, please, to item 3G, 8VC Fund 6.
So refer to page 517 in the materials. We're recommending a commitment of up to 15 million to 8VC Fund 6 as part of the New Mexico program. You know, as we've been developing the strategy the past 5 years in this program, there's kind of two critical elements in terms of a barbell. It's a combination of company creation engines and groups on the ground with presence here, a venture studio like Roadrunner, accelerators like Antler and Up Partners, as well as some other local groups like Dangerous, which really act as a magnet to attract highly qualified companies and founders to the state. Some of them are local, some of them are national. They have an interest in spending time here. Some of them we're finding out, are even international. And then the other part of it is a group of managers at the national level that are make sense or invest strategically in the sectors that are, you know, part of our state and are firms that founders aspire to raise capital from. The interesting thing about 8VC is they're a little bit of both. They have what's called 8VC Build, which is pretty unique in the venture capital industry, where it provides a mechanism for their employees to actually create businesses to the extent they can't find somebody already trying to build that business. We think they're one of the most entrepreneurial venture capital firms in the world. And they also strategically invest in the sectors that New Mexico kind of shines at. So we think they'd be a great addition to the program. And ultimately, there'll be a lot of synergies partnering with them longer term. Pass it to Richard for some more details.
One of the key strategy components that we were looking at when we started reshaping the New Mexico program more than 5 years ago was we really wanted to get these managers that had a strong track record, well-established resources that could provide some benefit to the state. We think 8VC falls into this category and it's the type of group that we had in mind with that focus. And 8VC is focused on early stage venture capital investments in US-based technology companies. This not only includes trying to find attractive companies out there, but as Chris mentioned, they actually form and create new startups that are incubated within 8VC through the Build program. And the firm utilizes its broad network of relationships to really find companies and entrepreneurs. It also has sizable operating resources as well for a venture capital fund to really help build these companies. And that's one of the things we've talked about too, is having those resources available to New Mexico entrepreneurs to help professionalize companies as well and get ready to raise capital nationally. Joe Lonsdale was one of the co-founders of 8VC in 2015 as a continuation of the strategy that started at Formation 8. 15 employees joined him from Formation 8, and the firm now has 10 partners, with all but 3 joining from the previous firm. In addition to venture capital experience, the team also really values entrepreneurial and operator experience, which is consistent with their strategy. And they've grown to approximately 70 people, with most based in Austin and San Francisco. Performance has generally been above median, with several measures ranking in the top quartile. And the firm's really been able to generate outsized returns across several investments. It's just something that we like to see in early stage venture, because, you know, we don't want to see just one home run. We want to see multiple companies that they've been able to hit on. Terms are generally in line with the other venture capital funds, and kind of the theme for the 4 commitments that we made today, there is a larger than average general partner commitment with this one as well. And 8VC has a history of looking at investments in New Mexico, although they've not made one to date, but their specific focus on deep tech aligns well with the strengths of the local economy. And in addition to potential new investments, there is that possibility of having existing portfolio companies expand into the state or utilize the BUILD program to help establish new startup companies in New Mexico. So we're recommending an up to $15 million commitment to 8VC Fund 6 for the New Mexico program. And I'll turn it over to Jin Young Kim.
Thank you, Richard. Thank you, Chris. Very nice to meet you. My name is Jin Young Kim. I'm a partner at 8VC. I was employee number 1 at Formation 8. So I've been building the firm with my partners for 13 years now. 8VC is, hello? Is that better? Okay. We are an early stage venture capital firm founded by founders for founders. And so the entrepreneurial DNA, both from Joe's background, our CEO and chairman, but also the rest of the partners really informed how we view early stage investing. So our bias is the very best early stage investors are people that have built successful companies and continue to build companies. And so that is really the genesis of the 8VC Build program. As Chris and Richard mentioned, the Build program for Fund 6 is about 1/3 of our strategy. And we're very excited about starting a partnership with New Mexico and hopefully spending more time here and building from this small initial commitment something larger in the years to come.
Thank you very much for being here. Do we have any questions relating to the 8VC Fund 6 commitment? Hearing none, do we have a motion?
Mr. Chairman, based on the recommendations of the Council Investment Committee, Advisory, Mercer, SIC staff, and General Fiduciary Oversight by RBK, I move that the State Investment Council approve a commitment of up to $15 million to 8VC Fund 6 LP, subject to the contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms, and conditions and completion of appropriate paperwork.
Second.
Motion by Member Sanchez, second by our State Treasurer. Any discussion on the motion? We take a roll call vote, please.
Treasurer Laura Montoya,
Yes.
DFA Secretary Wayne Probst,
Yes.
Nick Taz,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
That's 8 in the affirmative. Motion passes.
Thank you again for being here for the presentation. Let's move on to item 3H, the real estate program, the Sculptor Real Estate Fund 5 with Director Sable and Townsend.
Chair, thank you. Mr. Chair, thank you. So we're here to make a recommendation. We're here to recommend a commitment of $200 million to Sculptor Real Estate Fund 5 and an additional $100 million in a co-investment sidecar vehicle. Why are we presenting Sculptor today? 3 key reasons: basically, very high-performing manager with an opportunistic strategy that is targeting non-traditional assets. When I say non-traditional assets, we're considering those to be assets outside of the traditional areas in real estate. So multifamily, industrial, office, and retail would be those more traditional areas.
I think are people on the phone able to hear?
It's a little light.
They're asking if you can maybe speak up a bit, or apologies.
I do a little closer to you.
Sculptor is unique in terms of, again, their performance, the opportunistic nature of the strategy, and probably most importantly, for the fact that they're focused on non-traditional assets, so those out of the main four food groups within real estate generally. The strategy involves control investments in the US and Europe, and they target returns on a net basis in the mid to upper teens. Sculptor focuses on mid-market assets in secondary and tertiary markets where scarcity of capital provides a richer opportunity set. The deal teams focus on highly idiosyncratic opportunities where granular bottoms-up underwriting can give the firm an advantage. The performance of the fund series first three vintages has been extremely compelling, finishing in the top quartile of all peers on an IRR basis. Each of the funds also has generated a material premium to the Odyssey equivalent IRR basis. What we like about the strategy, the point that I'd mentioned previously on the idiosyncratic focus of the underwriting, this creates a broadly diversified portfolio that is expected to be resilient to general market shocks because of the low levels of correlation within the portfolio itself. Sculptor is focused on niche properties, and they have developed a very rich experience set in that marketplace. They've invested in over 200 deals across 30 different property types, accounting for more than $20 billion in enterprise value. Some of the assets that you would see in a Sculptor portfolio could include drive-to ski resorts, cold storage, golf, parking lot operations, RV campgrounds, and marinas as a couple of examples. So I would argue that while this is a diversifying strategy with respect to the overall real estate portfolio, you could also conclude that it's diversifying with respect to that other bucket as well. These are quite unique assets that they would tend to invest in. I think I'll pause here and hand off to Rob.
Okay, good afternoon or good morning again, everybody. Yeah, so what we like about Sculptor, as Keith said, access to the niche and diversified property types. But the platform here is really kind of a boutique within a larger firm. The real estate team's been in existence since 2003. It's been run by basically the same people, Steve Orbach, Nick Hecker, who's here today, and Corey Perlstein, have managed the real estate program since its inception in 2003. We like the alignment of interest that they bring to the table. So they've been very successful in the past, but they've been rolling their profits back into the fund series. So up to $50 million of GP co-investment in this fund, and 80% of that is put up by the professionals involved, the team, if you will, versus the house. And the real estate team has negotiated a large share of their promoted interest. So almost actually 2/3 of the promoted interest that they earn stays with the team, the real estate team, versus being taken by the house. So we like that as an alignment of interest in this platform. And as Keith said, the track record's very good. The platform has been investing in New Mexico. I think Nick will talk a little bit about that. And Keith has been able to negotiate a very good fee deal for New Mexico SIC. So from a cost basis, it's you're getting it at a good fee on this one. So all things considered, we're recommending a commitment of up to $200 million in the fund and potentially up to another $100 million in a co-investment sidecar with Sculptor, Fund 5.
Thank you, Mr. Chairman. Thank you, members of the council. It's a real privilege to be here with you today and to talk about our business. I'd also like to really thank Keith and Rob and Townsend for all the time that they've spent and the extensive due diligence that they've done on us. My name is Nick Hecker. I'm the Chief Investment Officer of Sculptor Real Estate. I've been with the business about 19 years. What I'd like to do is spend a few minutes just talking about our firm, our organization, and a little more time talking about our strategy, which I think is what makes us unique. The business was started about 22 years ago. Our main flagship is our opportunistic equity fund series. We have to date raised and invested 4 opportunistic equity funds, and this is now our 5th fund that we're talking to you about. We've just started investing that fund. Our most recent investment, our 2nd investment of that fund, is actually a portfolio of hotels, a financing on a portfolio of hotels that includes the Hilton Santa Fe, where I slept last night, so I recommend it to everybody. Along the way, we've also developed a real estate credit fund series and a real estate more core plus open-end type series. The key to our business has been our team. We have 39 individuals. 8 of them are in the firm's London office. The balance are in New York, and we cover all of North America and Europe. As Rob said, the consistency of that team has really been what has allowed us to develop a unique strategy, continue to refine it, and implement it over the years. So the partners of the business have all been together since Fund 1, so around 2 decades of working together. And then even other members of the team, we have plenty of people that have been with us for more than a decade. And again, it really is that consistency that allows us to underwrite, source, diligence across a wide variety of asset classes with a great deal of consistency. As was mentioned to date, we've raised about $12 billion of investor capital. We've invested in about $24 billion of real estate assets. I'll spend a few more minutes just on the strategy, which I think Keith and Rob did a very good job of explaining, but to spend a little more time on it. We will invest in those more traditional asset classes, office, apartment, retail, but we're really only doing it when the markets are very dislocated. And arguably, right now, there is certainly some of that dislocation. But the vast majority of what we do are in these so-called non-traditional asset classes. And as Keith was saying, it's everything from leisure-related asset classes like golf, drive to ski mountains, digital infrastructure assets like cell towers, which we've also owned portfolios of in New Mexico, all sorts of specialty housing and healthcare-related housing, again, something we've owned in New Mexico, and then other things such as parking, convenience stores, and gas stations, which is something else we've owned in New Mexico. And the reason that we do it is when you think about the underlying demand drivers for those asset classes, they really are different from broad, traditional, macro-correlated real estate. And so if you think about a portfolio that has some digital infrastructure, some leisure assets, convenience stores and gas stations, some senior housing, it will be much less macro-sensitive than if we just had a highly correlated portfolio. And on top of that, the markets are less competitive. Real estate has become a very efficient asset class, but the non-traditional assets remain a much less competitive marketplace, which means in order to generate opportunistic 20% plus returns in traditional real estate, as competitive as it is, managers end up using a lot of leverage. And by contrast, what we do is focus on asset classes where there isn't as much competition. And so as a result, we don't need nearly as much leverage to generate those same 20% plus returns. So we think we're both downside protected through the diversification of our portfolios, but also downside protected through the much lower amount of financial leverage that we incur than a typical manager. With that, in terms of the chronology of the business, and I apologize, I know we have some slides up, maybe a few slides forward if you don't mind. We've built this business, one more please. We've built this business over 20 years, and the diversified strategy has really been the key to the growth of the business. Every year, we generally add 1 or 2 new asset classes, and we think about all of those asset classes as having more tools in our toolbox, which means depending on what's going on in the capital markets environment, in the macro environment, we can pick and choose from, again, a large number of arrows in the quiver to really construct portfolios that we think are best suited to be resilient and generate attractive returns in the environment that we find ourselves in. And so we think about the growth in our business by expanding outwards to different asset classes. We've done that. That growth has happened in lockstep with how we've grown our team. Because as we add new team members, they get more seasoned. They can cover new asset classes. The older people can expand their reach to new asset classes. And so we've very steadily and systematically grown over time. And then if you flip one more page, because we have this expertise now across such a wide variety of asset classes, it really gives us a competitive advantage when we're looking for other asset classes, because a lot of what we do is tangentially related to a sector that we already cover. And so it's really given us a platform where we can more easily expand outwards and continue to grow the portfolio, continue to have more tools in the toolbox to generate attractive returns. And just on returns, we have been fortunate that our three basically fully realized funds, all top quartile. What we think is especially important about our track record is the consistency. We've invested these funds over very, very disparate investment environments between financial crisis, pandemic, interest rates spiking, and yet our returns have been very consistent. And that's really a function of our portfolios looking very different from one another. The allocation between traditional versus non-traditional, and then even within the non-traditional asset classes, what we're allocating to, we change very dynamically over time to create stable returns, which we've been fortunate to be able to do with, again, much less leverage than a typical opportunity fund manager. So hopefully that gives you a good overview of the business. I'm happy to talk more about opportunity set in the market today, but also want to be cognizant of time and answer any questions.
Thank you very much for your presentation, for being here with us today. Any questions for Sculptor? Madam Treasurer?
Thank you for your presentation, and for investing in New Mexico. Just one question. You mentioned a lot of the consistency that has allowed you to have a good rate of returns. I did notice in the packet the key person risks and senior turnover. So if you could just go a little bit into the detail of that end, I'd greatly appreciate it.
Sure. We've had very limited turnover. We've had one partner leave over 20 years. We've had, maybe a handful of managing directors over that same period of time. And I think the reason for the consistency, it goes hand in glove with our strategy. By always finding new things to invest in, we keep our team very interested in what we're doing. And so we continue to find people who challenge themselves and are able to grow within the same organization. And that has really been the key to the consistency of the team and the consistency of the returns.
Thank you.
Thank you. Any additional questions? Is there a motion?
Mr. Chairman, based on the recommendations of the Council Investment Committee, Advisory Townsend, SIC staff, and general fiduciary oversight by RVK, I move that the State Investment Council approve a commitment of up to $200 million to Sculptor Real Estate Fund 5 LP and up to $100 million to a related co-investment vehicle subject to the contingent upon the New Mexico legal requirements, New Mexico State Investment Council policy, negotiation of final terms and conditions, and completion of appropriate paperwork.
Mr. Chairman, I second the
Second.
motion.
Motion by member Sanchez, second by our state treasurer. Could we, any discussion on the motion? We have a roll call vote, please.
Treasurer Laura Montoya,
Yes.
DFA Secretary Wayne Props,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
That's 8 in the affirmative, motion passes.
Thank you again.
Thank you so much.
We will now move on to item 3I, presentation by Director Dunn on the ex-US Public Equity Diligence Review and Prospective Portfolio.
All right, thank you, Chairman. So my presentation today is really a continuation on the presentation I made last month. So in your books, I've included the same information, excuse me, regarding the structure study recommendations, the RFP due diligence process, and the portfolio construction process. And following that information is a staff memo, an RVK profile, and investor deck for each of the remaining 8 managers that we were recommending as a part of this whole process. So as a reminder, this is a consent agenda voting item. So like last month, my focus will be on the process and the portfolio that resulted from that process. We won't be going into detail on each investment manager, but we're happy to take any questions that you have about specific managers, and we do have a representative from each firm on the Zoom today. So with that, I'm just going to hit a few highlights from the presentation I gave last month. I'm not going to go through it slide by slide this time, but if I skip over anything, or if you guys have any questions, feel free to jump in as I go along, and I'll try to be brief here. So slide 635. This is the structure study recommendations. So as you'll remember, we performed a structure study that was approved by the council in May of last year. The recommendations that came from that structure study were, number one, to maintain broad international equity exposure with a similar risk profile and outperformance goals relative to the current portfolio. We recommended, and the council approved, transitioning passive investments from World ex-US to All Country World Index ex-US mandates. So as we've talked about, this is moving from developed market-only strategies to All Country World Index strategies, which include developed and emerging markets. So to Vince's point earlier about getting some active allocation management to emerging markets in the portfolio, that'll be happening on a manager by manager basis as they're finding opportunities within their specific strategies. Another recommendation was to expand the mid-cap portfolio from one core passive strategy to also include active value, growth, and core strategies, to expand the roster of large cap managers to reduce concentration risk and increase tactical flexibility. And really this is to accommodate the growth that we've seen in assets and the continued growth that we expect. It also provided an opportunity for us to identify replacements for managers who've underperformed and or have had significant changes to key personnel or just don't fit the new portfolio structure. So following the structure study, we initiated our search process. So the objectives and philosophy of that process were to minimize non-investment risks related to firm culture, turnover, any legal issues that a firm may have, to evaluate key drivers of value creation for each candidate, which is really to understand what they do and why it is that they've underperformed in the past, and understand whether these candidates are well positioned to replicate performance in the future. So our general philosophy is to focus on asset managers with clearly defined processes and philosophies that they've applied consistently over time. We do believe that markets are largely efficient, but strategy differentiation can add value. So primary points of strategy differentiation that we look for are scale and stability of resources deployed, having that sound and proven investment process and philosophy in place, an ability and willingness to take risk. We don't want to invest at active fee levels and managers who are really just closet indexing. And we're looking for that consistency of style and excess return pattern. So as we own a strategy in our portfolio, we have a good understanding of what their style is, so we can recognize if and when they deviate from that. And it helps us monitor and evaluate as time goes on whether they're meeting the goals that we want them to meet in our portfolio. So the RFP is the next step in that process. We released that in June of 2024. Page 638. We got a significant market response, 71 investment strategies submitted for evaluation. So at that point, we started our due diligence process. I have the 5 steps of our process on page 639. Step 1, we evaluate strategies for the minimum qualifications and style fit. Step 2, we take a deep dive on the firm. Step 3, we start evaluating the product, team, platform, and start thinking about how it fits in our portfolio. Step 4 is where we've whittled it down to a smaller group and that we want to focus on, and we conduct on-site due diligence with every manager. With myself, Ryan was present for all of those, and we always had a member from RVK with us for that on-site due diligence. And step 5 is where we're at today, where we present our recommendations to the council. The next few slides are just more detail on what that due diligence process looks like. We went into it last time, so I'll skip over it this time. The next step in the process is the portfolio construction. So I think it's important to point out that the last time a major reconstruction happened was in 2015. And actually, I shouldn't call it a major reconstruction, but the last time there was some movement in the portfolio, it was a $3.3 billion portfolio, and today it was 8.8. As we put this together, it's over $9 billion today. So that kind of plays into expanding that roster of managers and broadening out and diversifying in that regard. So the objectives, the overall objective of the portfolio is not changing, and that's to generate 50 basis points of excess returns after fees. The important considerations are to remain diversified across manager types and investment styles, to limit portfolio risk by maintaining small differences in country, sector, and market cap exposure. And we want stock selection from the active managers in the portfolios to be the primary driver of excess returns and non-benchmark risk. Skip ahead to slides 646 and 647. So you can see where this process took us in terms of changes from the current portfolio to the prospective portfolio. We have some managers that will persist on in the new portfolio because they meet the guidelines of the structure study. There's a handful of managers that we're moving on from because they've had PM changes and they've also had underperformance issues. And we have a couple strategies, the factor-based strategies or smart-based strategies. We had 2 of those in the portfolio that don't fit the new structure, so we're moving on from those as well. And you can see what the new portfolio looks like on page 647. We now have it segmented between large cap passive, small/mid cap passive vehicles, and then a non-US large cap active sleeve of managers, diversified across dedicated value managers, dedicated growth managers. These are mostly fundamental managers, but we do have a quant manager in there, or a couple of quant managers in there in LSV and Acadian. And then we have a SMID cap sleeve, which we previously, as I mentioned, our SMID cap exposure was all passive. So now we have a sleeve of active SMID cap managers across value, growth, and we do have a couple of quant managers in there as well. Importantly, the tracking error and beta at the bottom of the page for the prospective portfolio are right in our targeted ranges with a tracking error of 1.3, a beta of 1.02. And then the next few slides just can show you visually how we're adhering to that goal of having market-like exposure in terms of our country geographic exposure, our sector exposure, our market cap exposure. And, you know, this is important, and this is something that we track along with the tracking error and the beta. We don't want to express, you know, big bets in this portfolio in terms of country exposure or sector or market cap. So we want that tracking error and that beta, the beta to be around 1, the tracking error to be low, and to deliver market-like returns. But because of our active exposure in the portfolio, have the opportunity to deliver at least 50 basis points of outperformance and hopefully more over time. So that's the end of that presentation. Do you have any questions regarding the presentation or any slides that you want to call back to that I can shed more light on?
Thank you very much. There was one question related to just if you could comment on our China exposure, both in the current and the prospective portfolio, and sort of how that's changing.
Yes, so our China exposure can see on, so on slide 648. So the China exposure would be expressed in the Asia ex Japan and within the emerging markets. That's a little redundant there. So we don't have specifically China here, but you can assume that Asia ex Japan is mostly China. So the perspective versus the current portfolio, that exposure to that region isn't changing a whole lot. We're a little bit underweight relative to the benchmark. And it is a geography where our active managers will be investing and actively looking for opportunities.
Understood. Thank you. And could you just confirm also, different than the private market commitments that we make, each of these commitments is liquid, and, if you decide to pivot, you're able to cancel those contracts and reallocate on relatively short notice. Is that correct?
Yeah, we have to give 30 days notice when we terminate a manager. But you're right, these are public market equities, so it's very liquid. As we make a transition, we engage a transition manager as we make a transition. So down the road, as we're monitoring the portfolio, of these, it's going to be a portfolio of 16 strategies. There's going to be some that don't work out, and over the next few years, as we figure out that they're not tracking to what we want, you'll see us come back with recommendations to move on. And part of the reason to expand the roster, in my mind, is to, when we have an issue with a manager, that we can move on from them quickly and then initiate the RFP process and go through that appropriate diligence to bring in a new manager. But in the meantime, we can reallocate that to the existing managers in the portfolio. We could put it into the passive vehicle, but not lose that exposure while we look to move on and replace a manager who's been underperforming.
Understood. Thank you. Are there any additional questions or comments for Director Dunn?
Mr. Chair, this is Nick.
Member Tejas?
Yes, so I just wanted to thank you very much for the enormous amount of work that went into this. Especially starting out with the fact that, in your RFP, you had about 71 different strategies that were proposed, and to go through that RFP process when you probably don't necessarily have to, according to, the rules and the laws. I appreciate that effort, because I'm sure that was no easy feat to have to go through all of that material and whittle it down to the managers that you've selected. And the information in the packet on all the background of the process and the thoroughness is just exceptional. So thank you for that. I just wanted to ask, how did you determine the commitment percentages to all of the different I guess managers or sleeves? So like when I look at the Brandis International Equity, International Large Cap, they're 7.5% of the equity funds that are going to go there, and then you have like 2.5% for dimensional fund advisors. How did you go through that and just determine, what is the percentage allocation that you've arrived at?
Yeah, so we kind of start high level and then gradually work our way down to the specific manager. So at a high level, we want market-like exposure. So thinking about the portfolio in terms of large cap and small cap. So we're at 75-25, which is roughly where the benchmark is in terms of large cap exposure and small cap exposure. So, and then thinking about how much passive and how much active exposure do we want. So we knew we wanted to, in speaking and strategizing with Vince and the team and RBK, that we wanted to increase our active exposure a little bit. So we are doing that. So we targeted 75% active exposure, up from 63 in the current portfolio. So that helps determine our active versus passive. So we've got 25% in the two passive vehicles, and then we've got 75% to spread across all of our active managers. And then we roughly want that 3/4 in the large cap. And so that worked out to, that roughly 7.5% per manager in the large cap space. And the reason for 7.5 is the large cap managers have more capacity. We can give a single manager more assets in that space than we can in the small cap space. So in the small cap space, we allocated 2.5%, which works out to about $225 million, which in my view, and I think RBK shares this, that's a pretty big allocation for a small cap manager, and I don't think you want to go a whole lot bigger than that. So that's how we landed on that percentage. And then, thinking about, you can see the balance between the value and growth in terms of style. So we've got roughly the same amount of value managers as we have growth managers. So that's how this portfolio essentially came to be. Hope that makes sense.
It does. Yeah, just wanted to get a little bit more background on how those percentages were derived. So with that, thank you. Thank you for the information. That's all, Mr. Chair.
Thank you very much. Any additional questions? I believe, Member Tejas, were you going to make a motion on this one?
Mr. Chair, we're gonna just move to item J, because I don't think there's a voting measure.
Correct, yeah. Yep, that was my mistake.
So I don't know what we need to do on item J, but I'm happy to make the motion.
Yeah,
So for item J, I think if there's any questions regarding a specific manager, feel free to ask those now. And like I said, we do have representatives on the Zoom from each manager. So if there are any specific questions, please feel free.
Understood. Yep. Apologies for the confusion. Yeah, we're moving to item 3J, and so giving members the opportunity to ask questions of any of the individual managers. Madam Treasurer?
Chairman, I think overall, my question would be to all of them, is there any idea of some of the investment being in New Mexico, or any type of connectivity with New Mexico, whether it's people that worked with you or people who, some of the business that you might be doing? Has that been a thought, or have you done some type of work in New Mexico?
I think I can address that, and then I'll open it up to any manager that wants to jump in. So their investments are international. So the stocks they're investing in are, won't be in New Mexico, won't be in the United States. So from that investment perspective, the majority of them are U.S.-based investment managers. So there could be opportunity for some kind of connectivity with New Mexico, perhaps in terms of recruiting from universities, partnering, something of that nature. I don't know, but I'll throw that out if there's any managers on the Zoom that want to speak to that at all.
And I think just for time's sake, if no one does have any comment, it's just something to always consider, because we have a lot of brilliant people in New Mexico that would love to work on aspects that are international. The other thing that you didn't mention today, but you've mentioned it 3 different times, is the detail of the process allowed for more openness, for more people to get involved. And then there ended up at the end of all of the results, a lot of diversity, not just in the different groupings, but the types of firms. And so I'm really excited about this one in particular. And I think that other sovereign wealth fund organizations should look at SIC for the type of process that you guys have done and how thoughtful that process has been and how fair that process has been. So I look forward to the new people that we'll be working with, and I appreciate all of your guys' work throughout this process.
Thank you very much. Any additional questions for the managers? Is there a motion on 3J?
So moved.
Okay, and we actually have a formal motion. Member Tejas, I'm happy.
Okay, I'll make the formal motion. So, Mr. Chair, I move that based on the recommendation of the Council Investment Committee, Advisor RBK, and SIC staff, I move that the State Investment Council approve commitments to the following ex-US public equity managers: Argot Investment Management, Causeway Capital Management, Lazard Asset Management, Acadian Asset Management, Dimensional Fund Advisors, Man Numeric, EAM Investors, Dry House Capital Management. The selections here are part of the slate of managers approved by the council via consent agenda in January and February under terms discussed and memorialized today, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I second.
Okay, motion by Member Tejas, second by Treasurer Montoya. Could we, any discussion on that motion? Could we have a roll call vote, please?
Treasurer Laura Montoya,
Yes.
DFA Secretary Wayne Props,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
That's 8 in the affirmative, motion passes.
Thank you very much
Thank you.
for your presentation. Okay, let's move on to governance matters, and I would recognize the chair of our governance committee, Member Allen.
Thank you. The governance committee has been busy meeting over some of the recommendations that you're going to hear about pay bands and about recommendations about new hires and improving the compensation for the members of the staff. I'm going to turn it over to our to John Clark to go through the discussion and lead the discussion that we have and present what all of the members of the governance committee have been supportive of.
Thank you very much, Mr. Chair and Chair of the Governance Committee, Member Allen. So the discussions with the Governance Committee have been very productive. I've gotten great feedback. I'm in the process of making some additional changes to the materials based on the meeting that we had last week, and intend to come to the State Investment Council with a set of pay bands for consideration at the March meeting. But again, I'm still working with the last slate of recommendations coming from the Governance Committee to just try to tighten this up. I've been really appreciative of the overwhelming support from the members of the Governance Committee and from the rest of the council on our need to staff up the agency. And I think the Governance Committee members have been very mindful of both our need to staff up, but also mindful of the fact that these are public dollars. So I really appreciate the support and the feedback that they've provided.
Thank you very much. Are there any questions or discussion on item 4A at this time? Hearing none, would move to item 4B. Recognize our Deputy Counsel, Ms. Chavez Romero.
Mr. Chair and members of the committee, good afternoon. On page 976 of your materials, you will find a 2025 open meetings resolution for your consideration. On page 980 of your materials, you will find a markup of the 2024 open meetings resolution, which highlights the changes that are proposed for this year. I will briefly touch on the substantive changes that are recommended for this year's resolution. So as you know, an open meetings resolution includes notice requirements and procedures for state investment council meetings, as well as for its committee meetings. Paragraphs 1, 2, and 3 of the open meetings resolution cover the procedures and requirements for the state investment council meetings, for its committee meetings, and for emergency meetings. Paragraph 1 covers requirements for regular meetings. There are no substantive changes that are recommended to this paragraph. It would simply require 10 days notice be required of any SIC meeting, and that an agenda be published 72 hours in advance of any meeting. That aligns with the State Investment Council's statute as well as with the Open Meetings Act. A substantive change is requested for paragraph 2, which deals with the governance, audit, and investment committee meetings. Previously, the notice requirement for those advisory committees was 10 days, and it is being recommended that that be reduced to 72 hours to allow the chairs more flexibility in calling meetings and in allowing them to address issues as they come up. And as this committee is advisory, is not a statutory committee, we believe that aligns with the purpose and intent of the Open Meetings Act. It is also recommended that the requirement for notice being published in a newspaper of general circulation be eliminated, because that also aligns with the ability to publish notice as soon as possible if notice is being given with 72 hours notice. In paragraph 3, that deals with emergency meetings. There are no substantive changes to this paragraph, except in the last sentence, you'll see that under the Open Meetings Act, it is required that within 10 days of an emergency meeting, the council must report to the Attorney General's office the actions taken and any circumstances creating an emergency when an emergency meeting is held. Typically, emergency meetings are done with 24 hours notice, and so that would remain. But the 10-day requirement, post-meeting reporting requirement to the AG would be limited to council meetings, since under the Open Meetings Act, that should not apply to meetings of its advisory committees. You will notice this is not a substantive change, but I want to point it out because it looks dramatic. In paragraphs 5 and 6, or what used to be paragraphs 5 and 6 on page 981, those are being stricken in their entirety. If you look at those paragraphs, they contain a lot of language that is duplicative of what is already contained in paragraphs 1, 2, and 3. So we're simply striking those provisions, and to the extent there are any technical requirements that are being stricken in 5 and 6, they've been moved up to paragraphs 1, 2, and 3. What used to be paragraph 9 that deals with provisions for virtual meetings, we are proposing to take out the lead-in language, which is really just COVID-19 era language dealing with determinations of public health and safety when virtual meetings are being held. Now we have virtual meetings we have virtual meetings with a physical meeting space with remote participation. So the lead-in language to paragraph 9, what is now paragraph 7, would simply be cleaned up and simplified. And paragraphs A, B, C, and D, just D and E, contain a lot of technical changes to remove repetitive language. What I will note is A, B, C, D, and E apply to meetings of the entire council. So these provisions relate to the procedures that will take place in meetings that have remote participation, and these apply to meetings of the entire State Investment Council, not to meetings of the individual advisory committees. And with that, Mr. Chair, I'm happy to answer any questions.
Are there any questions related to the open meetings resolution? Madam Treasurer.
Thank you, Chairman. Thank you, Ms. Amy. I don't expect the pandemic to happen again, but if we were to have something like that, are we covered under the 7, or should we keep the old 9 in there just in case something like that were to happen in the future?
I believe that we're already covered under the 7 because actually in paragraph 4, we already have procedures for remote participation in place, and those have been in place for quite some time, even before the pandemic happened. So now there would be procedures in place for virtual meetings. We have them now. There would be a physical meeting space from which the meeting was held. If necessary, we could still hold the meetings virtually, allow for remote participation. So that's covered. So I believe it would be covered.
And then, Chairman, on the 72 hours, I completely agree with that instead of 10 days. And we usually get most of our packet the week before because of CIC. But on that 72 hours, will the council still get their packets a little earlier? Just because like today was 3 of these, so that we have time to review them?
Yes.
Thank you very much. Any additional questions? Hearing none, I will go ahead and make this motion based on and consistent with the resolution set forth in the public meeting materials. I move that the State Investment Council approve the 2025 open meetings resolution.
Second.
Second from the treasurer. Any discussion on the motion? Do we have a roll call vote, please?
Treasurer Laura Montoya,
Yes, sir.
DFA Secretary Wayne Props,
Yes.
Nick Cass,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
It's 8 in the affirmative. Motion passes.
Thank you very much.
I just wanted to thank Amy personally, and I wanted to highlight for the council that her 1-year anniversary is 6 days ago, and, you know, we are, in my opinion, I'm sure most people would agree, so lucky to have her. She is probably, in my opinion, one of the, if not the best state government lawyer that I've encountered in the state of New Mexico, and in fact, anywhere. So I just want to, of course, say happy anniversary.
Happy anniversary to you.
Thank you very much.
Mr. Chairman, I would also note during the legislative process, I first met Amy, she was a drafter. And so you guys having a lawyer that also was one of the best drafters in the state of New Mexico to help you through all those pieces of legislation is pretty nice because she already knows all of it, like the back of her hand. So we are very fortunate to have you, and we can let Alex know we're glad that you're here with us instead of with him.
Absolutely. Thank you very much. Let's move on to item 5A, finance matters, and recognize the chair of our audit committee, Member Tejas.
Thank you, Mr. Chair, members of the council. We met yesterday, the audit committee met yesterday to just review some of the items that apply to kind of our work and went over sort of the very defined audit schedule. Brent will talk a little bit about the actual financial reports that he reviews with us in the meeting here in just a moment. But we had a really nice conversation with the state investment officer related to legislation that, can affect, different areas of the SIC, but in particular, the funds that are managed. And so we were able to talk in depth about that. Just thanks to John for that conversation. And with that, that at a high level, in terms of the audit, we're still sort of in the early stages. I don't think that, of course, we have our agreed upon procedures that, we conduct or Brent conducts during the year, which are incredibly helpful. He mentioned that there's some, I think there was some potential changes to that. It looks like maybe the state auditor is not going to move forward with those things, but I think Brent can elaborate on that a little bit more. But yeah, the audit, gets going at the end of the fiscal year. And so I think that that's what we're going to be gearing up for here in just a bit. So with that, I'll turn it over, Mr. Chair, to the CFO for the SIC, if that's what you'd like to do.
Thank you very much. Recognize our Chief Financial Officer.
Mr. Chairman, probably 4 items I want to hit on if I could. I just wanted to report on the status of the agreed upon procedure reports for the last 2 quarters. That's September ending and December ending. If everybody remembers, those are kind of done simultaneously because we didn't want to have any conflicts with the regular audit that's done in the latter part of the calendar year. So I'm not anticipating any problems with them. That's Moss Adams hitting their March 31st deadline. I think Nick mentioned a meeting with the state auditor's office. Actually, a couple of weeks ago, Corey Hogan, who's the partner at Moss Adams.
Is Brent's microphone on?
Your microphone.
It is. Can you hear me better now?
Apologies.
Okay, apologies. Several weeks ago, we got contacted by the state auditor's office who wanted to discuss the agreed upon procedures. And you're always a little leery as to how they might want to change things. But we set up an appointment last Monday and went over and met with Ricky Ballerano. It was a very good meeting. After that meeting was concluded, a couple 3 things that I probably should report on. The AUP reports going forward will now be publicly available. To be honest with you, I didn't know that they weren't in the past, but that was something that the state auditor's office needed to work out with Moss Adams. So going forward, they will be publicly available. It was decided that there was no changes in the agreed upon procedures from this point, and they've been pretty much the same over the last 10 years, but focusing on the purchases and the sales, and that would include the contributions and distributions as they relate to the private investments as well. And then something that I think is very interesting, and I think everybody should be familiar with this or made aware of this, especially the state treasurer. He made it sound like they were trying to make some changes as to future RFPs, and he called those RFPs more market driven. And that's going to be something that will not impact us for this fiscal year. We still have 1 more year with Moss Adams, which they've already bid on. But I think they're going to let the market forces kind of take over a little bit and see how that maybe impacts pricing going forward. My guess is pricing will go up. And from my point of view, as it relates to our audit in particular, our audit fees should be at a minimum twice, maybe 3 times what they are right now. And whether or not the CPA firms actually adjust to the market-driven approach, I don't know, but we'll have to wait and see on that. Typically what they do is they like to look at what's been bid in the past, maybe adjust it up 5–10%. I think they need to take a better approach to that, especially for an entity such as ours with $60 billion in assets. The fact that we're paying, less than $150,000 a year I can't recall, and I come from a national Big Four background, ever seeing an audit priced as cheaply as ours. So I'm thinking that maybe if they let these market forces maybe intervene a little bit, maybe we'll get more regional firms and maybe even some national firms interested in our audits going forward, which really excites me. And then the final two items, I think John earlier mentioned the SBIC. We did do a true up to the SBIC based upon the fiscal year audit that just ended. They get 2% of the total balance in the severance tax permanent fund. So we did a wire last week for $28.3 million. I think John mentioned, and I think this is a good point to really emphasize, that their returns are below market. They shoot for 2%. I think looking at their last annual report, based upon what I gathered, they hit more in the neighborhood of 3%, but you can still see it's well below market compared to some of our other investments. And then lastly, since I've been here, every year when we do the appropriation request, we always request bar language as it relates to investment fees. This year, there's been a little pushback from the legislature on that bar language. Thus far in House Bill 2, we do not have the bar language that we've had in the past. We still have a 5% bar authority, but the other part of that, if you exceeded that 5%, has not been addressed. I think we're probably going to be okay, but I wanted everybody to be aware of that. It's an issue that John is really familiar with and is working on, and I have high hopes that we get some changes made before the end of the session, but we'll have to wait and see on that. Other than that, I'm open to any questions anybody might have.
Looks like our state treasurer has a question.
Hi, a couple of comments. The state auditor did mention to me that he was going to be meeting with you all and making some recommendations. I didn't know about the market. That sort of concerned me on my end because of the cost that would come with it. And I'm already over budget. The second thing is on SBIC, because I do sit on that. I would remind everyone on the council that the 2% might be a lot lower, but the type of work and the items that they're doing to improve New Mexico with business, that was more of the purpose than the idea of them having a bigger rate of return. And they have really significantly been able to help on the small business side in ways that SIC or Stowe or anyone else are not equipped to do. On the bar language, I am very concerned about the bar language. I have bar language also on the LGIP, the 5 basis points that you guys are very familiar with on the medium term. And I've just been told also that I'm not able to get my own bar language. And I just also found out that IT has $500,000 that I didn't know we were going to have to pay on. And so my question to you is, on the IT side, are there other expenses you're not familiar with or that have come up in the fiscal year that are also going to impact potentially where the bar could have potentially helped you? Or other items similar to that that you're not familiar with during your fiscal year, and then you get hit with them, and then that's where you could potentially use your bar language?
Treasurer Montoya, concerning IT, at least for fiscal year 25, the fiscal year that we're in, we just requested a transfer of 200,000 from the 300 category to the 400 category as it relates to updating of our file servers. Going forward, I think they're also focusing on the transfers, not just the bar. The transfers are, you're not increasing the overall budget, but transferring within categories. I'm kind of waiting to see what happens there, but I think in fiscal year 26, I'm not anticipating any IT problems as far as the budget is concerned. You know, investment management fees, that's another category. And I think we're going to be able to navigate that, but, you know, depending upon how many additional funds that we get, how much our assets grow going forward, some of this I can project. I can't necessarily project new funds coming in the door. So it's really incumbent upon us, and not to put a lot of pressure on John to see what it can do there, because as much flexibility that we have built into the processes, it's going to serve us well going forward, just because we're not static, we're constantly changing.
Thank you, Chairman. And I think our secretary is here too, so he's a very good asset to explain why the bar authority is so important to some of those bigger agencies that can't expect all the unexpected. So great partnership. Thank you.
Thank you very much. Any additional questions on the CFO report? Hearing none, we'll move on to old or new business. Hearing no old or new business, our next SIC meeting is Tuesday, March 25th at 9 a.m. here in the Parrott Conference Room and via Zoom. Do we have any public comment?
Mr. Chairman, we do not.
Okay. Hearing none, is there a motion to adjourn? Motion from the treasurer. Is there a second?
Second.
Second from Member Sanchez. Any objection? Okay, we are adjourned. Thank you very much.
Have a great day.